that's like that's pretty much it. That's the summary of it, right? It looks like things are gonna break down,
Yep.
and if the feds come in, they do something about it, then this game will continue.
Yeah, so we're gonna go to the 50 of May, which is a pretty big move,
Yeah,
and then
yeah.
we're gonna go to the 200 after that. Either way, we're going to the 200, in my opinion.
Yeah.
Sure.
So let me see this real quick. Test. Okay, so this should be alright. That works. This way. Make sure on those times. Okay. Share my screen. Hey John, welcome in, man. Again,
I'm so
which is
glad that you realize how important the Federal Reserve and all the reserve banks are to the whole entire thing. It's like crucial, not something people would pay attention to.
yeah.
It's so important.
I agree. Like I mean, prior to I guess all these years, right? Like when you first start off, you're just kind of looking at one stock, right? And then you learn about the stock, and then you want to get a little bit better. You start looking a little bit bigger, maybe look at the sector, but eventually you hit the index, and then from the index, you kind of start looking around the world, and then you dive into like I guess economic fundamentals. You look at like earnings and GDP and all that.
Right.
But then like you also think about like the money supply or the money in circulation, and so that kind of leads you to central banks. And then once you start, analyzing them and see how they operate, over time you start to realize like, well, they're they're in a cornered position, and so yeah, and then you're just like, well, it seems like the game is very dependent on what they do at least.
Yeah, they're a big portion.
I mean, yeah, if you go for a finance degree, they do talk about central banks, but I would stress that they don't talk about it enough.
Yeah, probably one chapter at the most.
Yeah.
They should be doing a whole semester about it.
Yeah, exactly. No, I agree 100%. And they don't have any strong security analysis classes. Like this investment club is basically security analysis, but then it's been transitioning to like global macro as of late.
Right.
But in general, it's security analysis. And I recall like looking at all the electives in finance in college, like it didn't have anything related to security analysis. So to me, it's like, what the hell? Like, well, they do have portfolio analysis, portfolio management, which is more like.
That's more generalized. They don't really go into the Federal
Yeah.
Reserve and its functions and how they affect the market.
Yeah, exactly. So it's more of a mutual fund thing. So it targets more like, okay, if you know this skill set, you're likely to get employed outside of college. That makes sense, but I don't know. I think security analysis is so critical, and most of the teachings are like, rarely at any institutions or colleges. I mean, and you kind of just have to learn on your own, or like some club like this, I guess. But yeah. So next week is that the week before Christmas? Yes, it is. Did you guys want to have a meetup? Did you want me to have a meetup?
It's up to you. I'll come. Because for me, the important night for me is the 24th, which is that we get together with family and stuff.
Yeah. Like for me, it's kind of like I won't be doing any open houses. I'll still be reading about finance. If I don't run this investment club, I'll probably continue reading my books that I'm reading. Well, it's more like reports more than books. Let me see who's online right now. Hey John, I know you're online. I'm just kind of giving it a second for people to come, and then we'll kind of get it started. I actually wanted to share this article today. I found this one pretty interesting. So you remember the oops, it disappeared right now. Okay, anyways. So okay, it did click. So the home analysts, right? That I found through just like word of mouth among money managers. This guy seems to have credibility. He's an actual investor, practitioner, and he lends to the space, et cetera, et cetera. So he has a track record of participating in the real estate market. And just recently on Friday, I found this really interesting. I only read it once, and you read it once, you kind of get a feel. I'm going to read it again, but I highly recommend this read because he says something extremely provocative in this. This is what he said: house prices in top metro nations could fall at least 30% and only be fairly valued. He feels like there's a housing bubble, right? Now I'm not trying to provoke or anything about real estate selling or getting you to transact, right? Just purely what I'm reading from an analyst and connecting what I see in the stock market. So I want to reread this one more time, but it does kind of make sense because doing some of the open houses here, I'm seeing like Santa Clara, the lowest end for a 3-bedroom, 2-bath, you're gonna get like 1.2 million. That's like the lowest it'll go, right? And I'm just thinking, sitting in these homes, I'm like, I can't believe people are paying 1.2 for this. It just doesn't seem worthwhile.
I saw an article too, like they actually had an article with numbers and percentages where like the overbidding has completely slowed down.
Yeah, this one.
Yeah, there was one that was basically, especially in San Francisco and some of the areas that went the highest.
Yeah.
The overbidding has completely collapsed, and now they're actually going under asking.
Yeah, so Silicon Valley, San Francisco inflection point, right? So this shows you, so in 2015, we had a lot of volatility in the stock market from 2015, 2016, and you can see like the active listings went up, right? But now with the recent, this is probably up until February, right here maybe. No, I'm sorry. Beginning of the year, and then this is like February. And then the volatility spikes, and then throughout the year you get a lot more listings. So it just kind of goes to show, like, this is interesting stuff to me, because it goes to show like there's correlation between the stock market and the real estate market.
And it's not a good combination when you got a lot of supply coming in.
Yep.
With people getting scared with the higher interest rates.
Yep.
And then
so number of reduced asking prices
yeah.
also increase. So you got more increased volume coming in, and then they're like, I want to sell for 1.2. Nope, you get like 1.5. So that's pretty interesting. I'm actually pretty excited. I mean, if this is like we're at the top of a super cycle, there's going to be a lot of opportunities, once it bottoms out, and then in the next cycle, right? Because that's when like the way I think of it is like, okay, in your trading, right? Let's say you follow a stock for the longest time, like Microsoft, and it kind of bottomed. And because you know so much, you've been following it for so long, that it's a bottom, a good bottom, you're more likely to leverage.
The only thing I see with that is you really gotta know when the bottom is, because you may think it's the bottom and keeps going lower. So in general, you gotta go back and study like the previous, how long they lasted.
Yeah.
And usually the market there, they last between 1 and 2 years.
Yeah.
Unless it's more extreme, like a 29 or 73, which goes 4 or 5 years.
Yeah.
So you're thinking maybe 1 or 2 years, then you're gonna be looking at your scenario.
Yeah.
So the bottom. So it's just knowing when, because 3 months from now, you say this is the bottom.
Yeah. No, I agree.
It depends on
Yeah. Hey guys, people online, I'm just kind of waiting for more people to come in before I get started. But if you guys have any questions, feel free to ask. I'm kind of just chatting with JC in the room right now. Yeah, this is what I see for our S&P 500 right now. This is probably the worst we've had it. There were some shadows over here, but now we're like confirmed like below this low right here. So I think things will get pretty bad. At least this is what I'm seeing so far. So waiting until what the Federal Reserve says, right? That could.
That April low right there on April is the key, if it's gonna hold or not.
This one right here. Yeah. That would be the next point that I'd be looking at. But overall, most of the trades will not do well. What I did today was I came up with a list of stocks that I think are doing well, that are fighting the trend, right? If the majority of the market is kind of going down, these are stocks that I found that are kind of fighting the trend. Some of them are gold. Hey, welcome.
Hi, good morning.
Hey, good morning.
Good morning.
Hey, welcome in. Nice to meet you. I'm Kay.
Nice to meet you, Belen.
Say again? Belen?
Yeah.
Nice to meet you.
Anywhere?
Yeah, feel free to sit anywhere. We're just kind of getting started. I usually give it like 15 minutes for people to come in.
Okay.
Are you first time to this investment club, right? Because I
Yeah.
don't think I've seen you before.
No.
Okay. Are you kind of like dabbling into stocks or?
I recently went to an educational stock. They were talking about shorting the market and all that stuff, but I've never really gotten into it.
Huh. What's the name of the meetup, if you don't mind me asking? I'm curious to know.
It wasn't really a meetup. It was kind of like You paid like.
Oh, you paid them?
They had different plans, and then.
Oh, okay, yeah. No,
It's one of those.
I've been to one of those before.
Or I think that they had like different plans, and you paid like $30,000 for the nicer plan, and they gave you.
That sounds like Online Trading Academy.
Yeah.
$30,000. I've been to an event. Hey Chris, I've been to an event where one of our members in here. So I don't really sell anything to people. But one of our members in here asked me. It was like a year ago, or more than 6 months ago. His name is Sachin, or SK. He goes by SK. And he finds this meetup where Kevin and Larry is going to be there, and we both end up going to it because it was like a trading seminar, right? But at the end there'd be Kevin and Larry, and I thought it'd be pretty cool to just hear what Kevin and Larry would talk about. So he's a heavy dividend investor, but for like the first I think 4 hours, we were getting pitched so hard by a trading services company. So they actually got everyone into a room, right, waiting for Kevin and Larry, and then in the back it's just like 3 or 4 doors to get out, and every door had like sales reps with tables and pens and contracts ready to go. So I was like, oh man, I totally see this sales event happening. What I notice about those events is that they don't give a lot of substance, they'll just kind of. I know personally, right? Because I read a lot of stuff about this. But what I notice is they'll just give you maybe out of the 4 hours, they'll give you 30 minutes of great content, and then the rest is just stories and pitching. So I'm not a big fan of those anymore.
I'm trying to find what the name is, but
yeah. Okay. Okay, so I'm gonna give it about 10 minutes, but I wanted to maybe ask you guys, or Chris, did you for 2019 did you want to see more educational stuff or more analysis, or just a fair combination between the two?
Neutral because I'm not. I guess whatever the norm is.
Yeah.
I came here to learn about technical analysis.
Okay.
So, I want to be more like an active trader.
Yeah.
There's a lot of things I was telling JC the other day. I know there's a lot of
bodies of knowledge and all that.
More indicators oscillator MACD and RSI and stuff like that. Just before I didn't believe it. I was more semi-strong, efficient markets, but now listening to the hedge fund managers, Sandra Miller.
Yeah, exactly.
It's okay, these big guys.
They're all using
technical analysis too. At least the entry points. And I'm kind of learning more about that too. So,
Okay. So more emphasis on charts.
When you have a chart up there, I'm on my own chart trying to see how do you
So I
that's what I dig about this.
Yeah, so I do apologize. For me, it's I've been doing it for a while, or just kind of drawing, annotating, all that. And I'll tell you this, in my head, when I look at a naked chart, I see the setups, right? So I'm kind of I kind of might just assume you know it, and then just talk ahead, right?
I know a good amount, but then just I guess that's why the other day I wanted to ask a basic question. The basic question was, how come he had 80 SMA and you have 50 and 100?
Right.
And and he explained it. It was 80 on a weekly.
Right.
So that's tough.
If you come here long enough, you're going to notice that I look at a very standard way of analysis or framework. It's basically everyone's framework, or the majority of money managers, what framework they look at.
Right.
So daily charts, and then the 200, 150, and 20. 20 is more of a momentum trader. Right, and if you notice for Bollinger Bands, it has the 20-day moving average. So I rely on those a lot. But for the most part, if I want to simplify it like this right here, I just have the 200-day my pink, and then the 50-day. So I hit the other. I made it simpler.
On a daily.
And the way I think about it is, it's kind of, in the beginning when it was technical discussion number 20, I was going super hard on technical analysis.
One thing on technical analysis too, what happens if you look at RSI, MACD, slow stochastic, any of those?
Yeah.
What happened, you have about, if you ask 100 people analyze stock, you're gonna get 100 different ways how to use them.
Yeah.
You're right.
Yeah.
So what you gotta do, you gotta find someone who's looked at millions of charts and has used them and already knows what each of them do and how it works. And when they gave you the concept, you can go ahead and pull up any stock at any time frame at any time and it will work.
Yeah.
So those are the kinds of things you want to learn.
Yeah. So to show you like how my mind thinks, right? So you see the pink line is my 200-day moving average.
Mm-hmm.
As long as it's above it, then I'm bullish, right?
Right.
And as long as it's above it, I start looking for the patterns above the 200-day moving average. I find the bullish patterns.
Right, like
Right.
that wedge we were looking at.
Yeah, wedge or bull flags, right? But now if it's below, now it's below right here, I should pick a different color. Now I start transitioning to looking for bearish patterns, right?
Yeah.
I'm a bear until it goes over. So very, very standard investor, I'd say.
The way I teach my son this kind of thing is basically, if you look at the 200 MA, we're going to look at the daily chart right now. If you look at the 200 MA, just think of it as like a cliff. And if you're above it, you're running on a mountain, just running. There's not going to be any problems no matter what's going on. If you ever fall below that cliff, then what happens is it prompts them to get into trouble in the future, and it could get worse and worse and worse. So if you're below the 200 MA on the daily, you got problems coming, right? But the only problem is going to happen below the 200 MA on the daily. And everything good is going to happen above it. So that is like a big cliff that you really get attention to if you're using the daily, right? If you use the weekly, you want to use the 50 MA as the cliff.
Yeah.
That is the key to the weekly.
So just to kind of give a quick review, right, and maybe like share with you guys the bodies of knowledge. There's fundamental analysis, which I know a lot of people will like as well, but it's kind of a boring subject to some. So fundamental analysis is the analysis of financial statements, the income statement, the balance sheet. But then there are, in between that, there's like mathematical ratios. So like the PE ratio and all that. We analyze that over time as well. So I don't know if that's a portion that you like. I like that because it helps me pick out these all-star companies, and then I combine it with technical analysis. So something like a Microsoft with very strong fundamentals, and then I combine it with technical momentum indicators or whatever, or patterns. And then those two kind of give me like, okay, Microsoft's an all-star, and right now it's running. I want to go long. Yeah. And then there's
Yeah, I think not so much. I know a little bit about.
We-
I know a lot about it.
Yeah. So we do go over a lot. So I just want to share with you the different bodies of knowledge real quick, and let some people come in. So so technical analysis is about, depending on which side you look at, right? There's indicators and oscillators. They're the same thing, but like MACD, RSI. So those are just all derivative indicators. They derive from price action. And when I say price action, it's just time, value, time, price, and volume. That's all it is. So they all derive from each other. So I don't look at it so much. I have it on. So this is all derived from time, price, and then the volume, right? So to me, they're always lagging. They're not as leading. For me to look at leading, I look at VIX futures. That's where we jump into a different segment. I would call that sentiment analysis, right? Sentiment is like, are people hedging? How do they feel? Like, you know, market breadth and stuff like that. Yeah, so that's part of technical analysis, I would argue. It's maybe just like a subset. But within technical analysis, there's indicators and oscillators. That's one body. The other body is like price action or patterns. So I love looking at price action and patterns.
That stuff I'm more naive to.
Yeah, okay.
Fundamental, Warren Buffett,
Yeah.
value investing, I'm familiar with, but like the technical and the sentiment, it's very interesting.
Yeah,
Especially
yeah.
a time like this.
Yeah, so probably in 2019 I'll ramp up the technical analysis and maybe like draw a lot more. I don't know. I want to like.
Get a consensus, you know.
Yeah, I'll get it.
I just started coming like a month
Yeah.
or so ago.
And then like I don't know if as of late you've been seeing a lot of global macro analysis, right? When we talk about anything sovereign related, commodities, forex, that to me is important because it just seems that that's the main topic right now.
Yeah.
Because everything's just moving in one direction, almost, which is down. Other bodies of knowledge, there's inter-market analysis. Now, this is where it kind of gets a gray area. Inter-market analysis is just basically you analyze the performance between, and we do it already, you just don't know it, the performance between the bond market and the stock market and the gold market and the dollar market. we're basically doing inter-market analysis. So maybe in like the last session, we performed like TA, FA, sentiment analysis, global macro analysis, and inter-market analysis. You just didn't know it yet, right?
Okay, and
Yeah.
another thing you can add is basically gonna be like crucial events that are gonna.
Oh, event-driven. Oh, so strategies.
Like crucial events that are gonna affect the market. Like for example,
Exogenous shocks.
like for example, like the Brexit vote.
Yeah,
We're
yeah,
gonna have, you know, the European elections, the Federal Reserve meeting,
yeah,
the government partial shutdown on Friday. Just all those kind of things. Just how it's gonna affect the market. If this happens, what could happen?
yeah. Every time something like that happens, I always jump back to the indices, because that's where the least amount of noise is. I don't look at an individual stock. Like one individual stock doesn't tell me where the overall things want to go.
Isn't that kind of hard to do if you're not an economist and like it's a different trends too. Like 2008 was a different trend than what might be next. You know, probably
Like,
another
I'll give you an
new
example.
debt crisis and business debt crisis.
I'll give you an example. Let's
Yeah.
take the 3-1 date of the China tariffs in the US, right?
What is it?
On March 1st, they're gonna go from 10 to 25% automatically, unless they have an agreement.
Okay.
So what would be something like if they don't have an agreement, that does go up. Market
What
gonna get
happens
hit,
to
market's gonna get hit like 100
Yeah.
S&P points, or plus more. If they do have a complete agreement prior to that, market's gonna go up 100 S&P points. So those kind of things are what could happen. Or the government shutdown on Friday, you know, if we have a shutdown, we're gonna go down like 20 S&P points, and if we have an agreement, we might go up 20. So net, you know, how much is it, how it's gonna affect it, like, what we think about it. Those
Yeah.
kind of things.
Yeah. So I mean, after a while, I mean, you could learn all the techniques, but I feel like you only need like a few techniques, or you don't need a lot to be super proficient. Like, if I were to just sum up everything you need, there's only a few techniques you need. Like a certain style of looking at charts. This would only apply to swing trading. I haven't talked much about day trading because I don't actively do that as much, but I need to. I feel.
That's what I'm doing.
You want to do day trading?
Yeah.
Yeah, so-
All this long-term stuff.
Yeah, day trading would be a different story, right? Because we always look at the daily. For day trading, I'll probably jump down to like 3-minute charts or 5-minute charts.
Or like reading the tape, like I was talking to, is this guy's name Aaron?
Yeah, tape reading.
Yeah, he was like
So-
showing me the tape and
Yeah.
stuff like that.
So I'm aware of that. I just don't participate in that style of trading. But I could tell you what I found works is the 15-minute opening range breakout or breakdown.
15 minutes of the day.
Yeah, the first
Okay,
15.
yeah.
So let me see if I find like a momentum stock or something like this, and then let me put in that setting. So
Yeah, that's what I read. Like smart money trades like in the first hour, and then maybe in the last tail or something like that.
yeah, so here's an example. Let's jump down to 3 minutes. Actually, I have a day trading setup. Intraday VWAP. No, I don't want to use that one. Nope, I don't want to use that one either.
So you know we could share each other's setup.
I think we can.
Yeah, but you can.
Okay, let's do this setup. Move all, add selected, apply. Okay, so this would be my simple intraday setup right here. Right, and what I have on, if I were to read it to you, this would be for day trading, and we're just going to talk about this for maybe 5, 10, unless you guys really want to talk about it, because I actually want to start talking more about it in 2019, just because of like market volatility.
Yeah.
Like I just can't hold anything too long right now.
Right.
I don't want to take a big hit. So what I have on is a simple moving average for my volume. It should be 50 though, but it's at 90. But anyways, opening range breakout, the 15 minutes, right? So from 9:30 to 9:45, it'll automatically draw something. And then I have VWAP on, and then the previous day's high and low. That's all I have. So this is the previous day's high and low right here. So we're going to zoom out a little bit. This is the previous day high, see the yellow? And then the previous day's low is the pink, right? So the yellow and the pink is from previous day. And then this colored area right here is the 15-minute opening range breakout, right? So when the market opens, I don't trade the open. I mean, if I were to do it, I wait like 15 minutes. So the moment after 15 minutes, if it's above the 15-minute line, like this right here, then I'd be thinking I'd be bullish, right? and then also above the VWAP. Now, let's say if I don't catch this trade right here, I could wait until later in the day, then I'll find, ooh, let me change this. So later in the day, I'll find like intraday support, right? This is intraday from morning till end of day, right? I'll find support and I'll wait for something like a breakout right here. I'll probably try to trade this right here, a breakout right here, right? And then take a little gain right here, something like that. That's why it's a.
Yeah, we're looking at the day right now. This is the whole day.
Yeah, this is just one day. This is one day.
And those lines it drew based on your on your inputs.
Yeah.
Okay.
So because it's above the 15-minute, then I'm bullish for the day, and then also the next confirmation is above VWAP. So if it's above VWAP and above 15-minute, then I have two reasons to be bullish. So I'll find for an intraday bottoming. Like right here, it kind of like use VWAP as like resistance. So maybe I'll wait until over here, then I'll consider long here. But then this would be a bad trade, right?
Yeah.
Until it goes back above, then I'll go long like right here, and then I'll catch like a little tiny move from 89.5 to this is a dollar move. Actually no. 50 cents. Oh no, that's a dollar move. About a dollar move. Right? So 100 shares, a dollar move, $100. Yeah.
Can we do analysis on this week's day trading for this theory and see if it works? I only did one day on Friday, but I lost 3%.
Oh, Friday is not a good day. What
Yeah,
are usually
I lost
the-
3 days, 3% for looking up positive for the market. It actually went down. The bottom supports line over this several volatility.
Yeah. So you want to look at like moving forward where I think the S&P, like what are you trading first of all? Like if you're day trading.
I trade 2 stocks.
Okay, so that's different. Like I would, okay, so at the same time you're looking at these indicators,
Yes.
what I have in front of me is it's just a one stock MongoDB, one day, and then with a 15-minute range in VWAP. At the same time I'll have like the S&P 500 and where it's going intraday.
Oh, yeah.
That's
so
important as well.
I do stocks with the S&P 500. One is TQQQ, another is TVIX.
Oh, you're trading TVIX? Okay. I think TVIX is bullish right now. So
So I lost.
So this one's different, okay? When we're talking about TVIX, I look at a different set of analytics, and I pay.
How about TQQQ? This is the same. Triple looking up for S&P 5.
This one is the triple leverage bull, right?
Bull, yeah.
Yeah. So this one's just a leverage. It's the same thing but leverage. So it's the same thing as looking at QQQ, but it's leverage.
You mean
3 times the pay.
Yeah,
3 times the.
So I see these 2 stocks as how to say opposite. So I can do day trading with these 2. So if I catch the right hand, I can.
So let me ask you first. Do you want leverage or no leverage?
So TVX.
So you're talking about like a pairs trading model. Do you want leverage pairs or non-leverage pairs?
I don't want any leverage.
You don't want leverage? Then you could go like SPY and maybe SVIXY.
SH.
SH?
Yeah, that's the inverse one.
Yeah, you could go something like this and then just pair straight this.
That's
Oh,
the-
sorry. I want leverage. Sorry.
You-
I just remember what does the vocabulary. Sorry, leverage. TVIX and
Two times. TVIX is 2 times.
Yeah, so I'm actually gonna talk about that today as well. So a little thing about I guess let's jump right into it for today's talk because it's already 20 minutes in.
Sure.
And we got quite a bit of people, and we'll answer your questions on day trading and stuff. People online, welcome. Today is just going to be a simple stock market analysis, and then I'm going to share with you like opportunities I see in the next coming weeks, or maybe in the next coming day to weeks. It's a tough environment. Ignore this part. This was just in the beginning. But a quick review from last week. I did show this. Right, it's still the same. Right, the top performance in the past 3 months. Number 1 is VIX. So TVIX is part of VIX, right? Did you guys have any questions about the VIX, Chris? I think you kind of understand it pretty well.
Yeah.
It's basically a fear index, right? Based off of like put and call buying on the S&P 500. I like to at this point I would safely say it's more of a USA S&P 500 index VIX. than like an international VIX. Would you agree with that statement?
100%.
100%, right? Because it's measuring put calls on S&P 500, not like, you know, a global index.
Correct correlation.
Yeah, because, you know, if you want to see like the European VIX, I don't think we look at that. It's not like a mainstream thing, but it exists. Because I know of a derivative product, it's EXIV. This is the inverse European VIX, right? So if you notice, it's XIV spelled VIX backwards, so it's the inverse, and then they put E as in Europe. So you know that might be something of interest, because I perform a lot of analytics. Well, I outsource my analytics, so I do subscribe to this guy over here. I personally, like I said, I don't think his trading calls are good, but he came from an architect background, and so he performs great analytics. So I pay him for the analytics, just to kind of gauge where things are going. But for his calls, I'm not a big fan. So for me, when I look at volatility as a trading asset, I apply a lot of analytics, or at least I look at a lot of analytics.
Just, I know that's what actually brought me to this club,
Yeah.
because Hatchin said that he was going to this volatility club.
Yeah.
He said, oh, I like trading volatility.
Yeah.
I
So
was like selling premiums all the time.
yeah.
That's what I thought this club was about, like you guys are options traders.
So no, we are.
But it ended up being great.
I mean, we.
I'm still here, yes.
No. We are. It's just you didn't come. Let me show you the blow up. So I don't know if you know, but XIV it blew up. Hey man,
Yeah.
nice to see you again. Let me see. So I do have pictures of it. Let's see. It would be in my database. OneDrive. XIV.
Got mine in March.
Yeah, so XIV got terminated. So, yes, so this club is called the Volatility Club for a reason. But if you know, back in like February, S&P 500 pulled back really hard. And so the volatility instruments, they actually got, the really good one got terminated. So this is XIV. XIV doesn't exist anymore. But when it existed, it was just an instrument that kept going up and up and up in a low volatility environment, right? Because central banks have been printing money for like the longest time. And so things just kind of kept going up. And then after February, it just got to a point where volatility was still low. Well, okay, it spiked, but short volatility wasn't a great trade anymore. All right, I'll give you an example. That short, if you wanted to short volatility now, like with XIV, you would use a ticker called SVIXY. Right, so this hasn't, look at the way it moved in like the past. Well, you can't look at this anymore, but it just hasn't been moving. So right now in this current environment with the volatility futures, now when I say volatility futures and talk about this is the analytics on volatility, right? So I'm paying this guy to get access to analytics of him calculating what the volatility futures are doing, right? This is the same way we look at the bond yield curve, but this is purely volatility. So that's how I'm able to trade volatility. So right now this is telling me that markets are fearful, right? Because it's pointing up. That's as simple as that. When it points up, and you could also, you guys don't have to pay, you could go to the free version, which is at vixcentral.com. Right, you'll get about the same type of information, but it's going to be 1 day lagged, right? So right now it's pointing up. That's telling me that VIX wants to go up, volatility wants to go up. So if volatility wants to go up, people want to keep buying put options, or, well, that's not really accurate to say, but there's a lot of fear in the markets and people are hedging. Right, so that's how I apply. Like, if you look at this, it doesn't give you much analytics. But if you go over here, the one I pay for, I get a full spectrum and understand, like, sorry, I'm kind of lagging. I get a full spectrum and understand what volatility wants to do a little bit ahead of time. As of late, I haven't been able to get much opportunity from this, because right now it's a long volatility environment. So
the XIV has its own algorithm to cause its termination. Do you agree with that?
it had its own algorithm? Well, every ETF has its own objective, which is essentially an algorithm, yeah.
Yes, so that when the fluctuating is 100% on one single day, it just goes down.
Yeah.
Well, the biggest problem with the TVIX is the way it was set up, right? So basically it was doing a percentage of the VIX. So if the VIX is stayed between 12 and 18 like it did for a long time, the VIX will go up a little bit, you know, the one that completely broke down. But when the VIX went to 40, imagine that was a huge move from 50 to burst, we have to go down 340% in a burst.
Yes.
So it just set up to burst as soon as we get any type of bearish market. It was designed, the mathematics was gonna do that, because you get a minus 300% drop,
Yeah. So my core technique, just to kind of gauge like S&P 500 direction, I leverage technical analysis on S&P 500 or USA indices. So I'll do technical analysis on Russell 2000, Nasdaq, Dow Jones, right, and then the mid cap index as well. That in combination, so TA on that, technical analysis on that, in combination with analytics on volatility. So those are my two weapons I use. Yeah. So what? Let's put that in real time, real quick, right? So over here, I'll look at SPY. What I see is SPY is breaking down. SPY is the S&P 500 ETF. It's breaking down. Things are looking really bad, right? What's funny is that the FANGs are breaking down way harder than the indices. So what I learned as of most recent is that Apple, Google, Amazon, Facebook, and there's one more. No, Apple, Google, Amazon, Netflix. And one would also do plus M, which is Microsoft. Microsoft's big too. It should be FANG plus M, right? They actually went down first, and then the indices. Except the only one is Microsoft. Microsoft's my number one favorite company. They're only down like 7-8%, versus like Apple at minus 28, Netflix at 30 or something. So it's just extremely scary. And I'm glad you came today as well, because I was going to share this article, right? So this will be towards the end. But if you guys know, Mark Hansen is one of the real estate analysts that I've come to respect because of another money manager I deeply respect, who gave this guy, kind of passed on a word of mouth credibility. So this guy kind of forecasted and is super provocative, okay? So I'm not trying to promote anything, but this gentleman literally said, well, maybe I should let you read it, but we'll go over it later. This is how he feels about home prices, right? House prices in top metros in the nations today, house prices could fall at least 30% and only be at fairly valued. Yeah, I'm looking at Chris's face. He's like, nah. So that's something interesting. And if you want to understand the dynamic or the framework of why he thinks that's the case, I would suggest reading this. I'll send you guys a link at the end of the club as well. So that's something that's kind of hard right now. Like when I do open houses and I meet a lot of buyers, it's tough because it's just not everyone is aware of the global macro environment, right? And you guys coming in here, I show you in real time what we're seeing around the world. It's not just the USA that's breaking down. It's Europe and Japan as well. And it got a lot worse. Speaking of indices, let's look at it real quick, okay? We'll look at the global macro index picture real quick. So at the very top, it's always USA. And I'll annotate it as well, just to make it easier. So at this point, this is where I'm lazy, and I think, because you want me to do more TA, right? Right now I'm doing lazy TA. But I'm doing I'm doing a quick intermarket TA, technical analysis, right? So what am I seeing for Dow Jones? It's breaking down already, right? What am I seeing for S&P 500? Already breaking down. Nasdaq, about to break down, right? Russell 2000. Remember, Russell 2000, small caps. It led the way into, it basically, what I saw before, I guess you could say, the October downturn, Russell 2000 went first, and then everyone else around the world went. So yeah, so what I'm watching now, if my thinking is, if Russell 2000, the small caps went down first, USA small caps went down first, and then everyone else around the world followed with them, then I want to see Russell 2000 point up first, before I can get like a nice 10%, I don't know, buy the dip rally, let's say. But that's USA. Looking at Nikkei, right? Because remember, this spillover effect hits the entire world. Looking at Nikkei, not quite yet, hasn't quite broken down yet. But look at this one. This one, or Europe, top 50 stocks in Europe already broken down, and it hit its head on resistance, right? Support, previous support right here, became now resistance. So that's looking extremely bearish, to me at least. Now, the next one, Germany, same thing. Prior support, now became resistance, right? Germany's a major developed market. And what we just analyzed here is like 1, 2, 3, 4, 5, 6, 7 major DMs, developed markets. We didn't analyze EMs yet. If you look at EMs looking even worse. What I leverage to look at EM is EEM, right? Emerging market ETFs. All you gotta do is just look at since let's do the weekly chart. Since the beginning of the year, February, EMs went down, right? So you just know everything in EM: Russia, India, Brazil, China's the second biggest economy, right? It's weird how China is not considered DM, but then it makes sense.
Is that?
No, it's not. It's not considered.
It's not?
It's considered an EM.
All right.
Yeah, but it's the biggest economy, the second biggest economy in the world. Yeah.
Don't look at it individually.
For the European Union, the way they rank them by size, is number 1 is Germany, number 2 is France, and number 3 is Italy.
Yeah, yeah. So I think they rank it by like GDP, but let's jump back to it. So now we have confirmation around the world it's looking really bad. So looking at the USA markets, performing just looking at the volatility futures curve, the VIX futures curve, it's telling me that in the next 30 to maybe 90 days, there's a lot of fear in the markets. So in the next 3 months, it's just going to look choppy, at least for now, until this changes. The moment it changes, then my view is different. But that in combination with seeing a breakdown in the S&P 500, plus the VIX futures curve is pointing up. Oh, it's getting blurry for you guys. It's pointing up.
Yeah.
That means it's in backwardation. That's a negative indication as well.
Okay, why do you say within the next 3 months? Are you looking at any specific deadline or certain, things?
Okay, so real quick, these
Can we
con.
just zoom
Huh?
zoom in again, so that we can make the text a little bit.
Oh, you can't see it? Okay.
Yeah,
No,
it's
it's
on
fine.
your computer.
Oh, on my computer. Okay, let me. Is it a little blurred? Let me just.
No, that's fine.
I think that's okay. All right, so sorry about that. So let me explain to you what it is. So this is a very sophisticated, like you guys hear how important the yield curve is, right? Does anyone in here not know the yield curve? It's okay to not know. I could explain it real quick. The yield curve. You know the yield. So you don't know the yield curve?
Can you just tell me some context? Maybe I can repeat.
Yeah. So the yield curve is talking about the treasury market, the bond contracts.
Oh.
Right, and it creates a curve because you got the 1 month, the 2 month, the 3 month, whatever, the 1 year, 5 year, 10 year, 30 year,
Yes,
whatever, right?
yes.
So that creates that eventually creates a curve,
Definitely.
and typically that curve's pointing down.
With the 5 years crossing the 2 years, or 10 years crossing 3 years.
So let me show you this right here. So I click on my futures tab right here, and then I click on the bond markets, right? And then right here you have the bond contracts.
Yes.
Now, if you were to piece these contracts, right, 105 to 113 to 120 to 142, you get a curve. And I guess if you want me to draw it out, it would be, let's say this one is 105, right? And then the next one, the 5 year is 113, right? And then the next one is 120, right? And then 142, right? So that's 4 contracts, and you get this formation. You see what I mean? So in a way, you're looking at the entire segment with just one curve, and that's the beauty of it, because you're kind of leveraging your analysis. If I were to go to my Guru Focus over here and show you a more detailed version of the bond yield curve, this is what it looks like right now. Where is it? Treasury, U.S. Treasury yield curve. So this is so important because it tells you how much they're printing or where interest rates are going. So this is what the curve looks like right now, right? And if you guys recall before, I said that in every recession, the curve would point up, right? So this gray area, so ignore the black and green lines right here. This is the S&P 500, right? So every gray area is a recession. So if you notice that I'll move this thing right here. So, okay, I'll play it. I guess I have to play it. Every time it gets near the gray, it'll point up. And when it point up, then that's really negative, right? So that's why you hear in the financial news media, they always talk about, oh, yield curve is inverted, right? So typically a year or two after the yield curve inverts, we get a bear market. So this is 2000, so it's moving slowly, right? So as it gets closer, so you see how it's pointing down, pointing down, pointing down, pointing down. Until it gets closer to the gray, it'll start to point up, right? And I'm using the same dynamic when I look at the volatility futures contracts, because now I'm measuring how these contracts behave. So now we have inversion right here, right? So it's inverted, 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 and then we finally hit a bear market, right? S&P 500 right here, the blue line, it drops, right? So now we move on to the next super cycle, right? Super low interest rates, that means easy money printing. You want to buy a home because the home will inflate in value, right? So for the past so many years, I guess you could say from 2013 and beyond to 2018, the curve has been so low. So that was like the best time to buy a house. Buy a house or buy any asset, because any asset will go up, right? And up until recently, interest rates are going up. So this is where we're seeing home prices are slowing down and record inventories are coming into the market. So you see how it's kind of it's going up. It's not pointing up, but it went higher. You really have to study the curve, if that kind of makes sense. What I'm saying is that you didn't see it happen, but it was like, it's still pointing down, but it was down here, right? But now it's pointing down up here, right? Until it's up here and it points up like this. That's like major concern right there. So that's a quick recap on the yield curve. Going back to the volatility futures now. Now I'm applying the same dynamics to understand the S&P 500, but I'm looking at volatility contracts now. Volatility futures contracts. And who trades the volatility futures contracts? Very, very sophisticated investors, not average Joe, right? Who trades them? You know, the bond market. Well, very big investors, but maybe not super sophisticated as these guys. So if anything, the way these guys interacted with each other, their collective interaction creates this, you know, inversion or backwardation formation, they call it. And that tells me, well, all the VIX volatility futures, the sophisticated investors are fearful right now. All right?
Can you tell me what is volatility and why I'm caring about it?
What?
What is volatility? What is the measure of it?
Like, what is the measure of volatility?
Yeah, what is the underlying
So volatility is, so if you look at markets long enough, you'll realize that everything is really dependent on maybe the S&P 500, right? And that's why we did a quick analysis earlier just now on all these, but things really follow the S&P 500. And so the VIX is another index that financial engineers created that is based off the S&P 500. So essentially the VIX is a derivative, it derives its number from the S&P 500. But the S&P 500's options players, so the bigger leverage players and how they decide to buy options on it. And typically money managers like mutual fund managers or institutional money managers, they buy options to hedge when things are going down. Right. So when the VIX spike, this is a detection of these big money managers are buying hedge. Right. And so that gives us a leading indicator. That's one indicator. But now I'm using the futures of the VIX. So a derivative of a derivative of a derivative to get even further indication of where the markets wants to go, but also getting into the minds, sort of the minds of these sophisticated volatility traders. So you see how it's like very derived, but every time they derive, the markets get bigger, if that makes sense. So like the options market is bigger than the actual the spot market or whatever. Right. So that's the explanation of the VIX.
So so somebody buys S&P 500 futures. This is much more derivative on top of that.
Yeah.
And so how long is this contract? Could be any long?
They're all standardized. So for things to have active trading, it needs to be standardized. Now, when we go out, so why is there so much friction in today's world, right? Let's say I'm Salesforce and I'm doing deals with SAP, right? Or SAP wants to buy my Salesforce product, which is CRM. We have to negotiate customized deals. And because they're not standardized, there's a lot of friction in between. But the electronic markets like this, futures and stocks and options, all the options contracts are standardized, all the futures contracts are standardized. So when they expire, this is what you have to service. Okay. Right? So because of that standardization, it's a lot more liquid because we could go in and out. Versus like unstandardized business contracts. But contracts are contracts at the end of the day. If you decide to buy a home, we get into contract, and it's the same thing. Back in 2008, what they did with the contracts was they gave the loan, right? The person would borrow the money and they would pay back the contract, but they would turn around and sell that contract to derivatives players who would buy the contract and re-engineer it, and they'll repackage it. So it's quite simple once you master it, but in the beginning it's super like it's like a force field, you know, because you don't quite get it.
How long is your typical VIX contracts are like 1 month? You're predicting
So the ES is, I think they have 4 contracts. So you could look up the ES curve, right? The S&P 500 futures curve, and that's 4. So I don't trade it. I don't know how many contracts because I only use it as an indicator, right? But this would be the E-mini contracts right here, and I think if I recall correctly, there's only 4. As soon as it loads. Yeah, so, there's more than 4. 1, 2, 3, 4, 5, 6. So there's 6. Okay. That's how many contracts. So You know, I think it's 4 though, to be honest.
Are you talking about options contracts?
No, we're talking about futures curve now. We're talking about futures contracts now. They're all derivatives, but it's really simple if you just think of it like this. Derivative contracts, there's options and there's futures. In options, in futures you're obligated to service the contract, right? In options you have the right to service the contract, right? But in options, if you sell it, then you have the obligation to service it. In futures, no matter what, it expires on you, you have to service it. That's the main difference. And we created that because, you know, it's out of necessity. Okay, before the S&P 500 futures, it was actually more like commodities futures. So stuff like soybeans or cattle, right? Because farmers, they purchase at scale to run their business, but they need a hedge. And so they're willing to pay premium, like you guys paying car insurance and home insurance. You're willing to pay premium to the speculator, which is not really the insurance company, it's not really speculation. But the investor, the commercial hedger, as you hedge, you have to pay that premium to the speculator. So the speculator needs to exist for you to hedge. For you to buy insurance and for the insurance to kick in, someone needs to speculate that. And so if you watch The Big Short, right, it was all about derivative markets. Michael Burry, he's just down the street. Michael Burry is the gentleman with the fake eye in the movie, if you guys watch it. He's just down the street. His hedge fund is called Scion Asset Management. He's just down the street. Right across from, if you guys know where Happy Lemon is, it's a milk tea place. Right there. I think the commercial building that he's in is by a builder an owner called Prometheus. I don't know if anyone knows that. Prometheus is so he's housed in that building. If I'm wrong, he probably moved down, but he's in this area, he's in this street. Yeah. So it's really super cool. That's why I chose his office, man. Like right across the street from here is also Silver Lake Partners. I don't know if you guys know who Silver Lake is. They're like the number 2 private equity firm in the world. But anyways, going back to topic. So did that kind of explain like how many futures contracts are out there and how it creates a curve? Now let's jump back to the volatility curve.
Can I ask you a
Yeah,
question
yeah.
on that futures?
Yeah.
Like, you have ticker symbol?
Yeah.
So can you put ES in there, /ES?
Now you could also pull up the curve in here. I just forgot how to do it.
Because I know there's futures options, there's futures, and then there's a whole option exchange for that too.
Yeah. So you could do options on futures as well. Yeah, it gets pretty complex.
Have you
Now-
done any of
No, I don't do any of that. I could maybe one of these days if I make a ton of money and I don't care about the money, and I'll go and be like, I'll go speculate on a derivative, and then I'll play that game. But for now, I'm trying to build up more of a recurring stream and like thinking about my long term. Like like out of college, you're kind of just you're like, I want to day trade and all that, and then after a while, you get that ego, you get the ego out of you, and then you just want to focus on like, okay, what's my long term plan? So. I want to build a future and all that, and then like also a network in this area, right? That's why we throw the mixers once a month. Yeah. So funny because so the real estate investment group that sponsors my mixer, they gave me my own business card today. If you want to check it out, if you guys want to pass it around, check it out. So I thought the title was pretty cool. They put me as strategic partnerships. So I don't work for them. I work with them, but they gave.
Exactly did you do with them?
Yeah.
What do they do?
So what they do is they do multifamily. I guess you could categorize it as commercial real estate investing. Their website is roof4all.com. But basically what they do is in a nutshell, they flip neighborhoods. You know how you flip a home? You buy a home. Yeah, you buy a home, you value add. No, this is different, not apartments. It's categorized as multifamily, I guess, but they're buying at scale. So in Texas, they have properties that cost like $25,000, and it's in very distressed areas. So what happened in 2008 was it caused all the homes to go down. And now in the new super cycle, right, you got Apple going to Texas and stuff, building $1 billion building. Texas is going up, but these distressed neighborhoods are not going up. And so the government needs help flipping these neighborhoods. So they're paying this company, the real estate investment group that sponsors me, Section 8 income. Did I say that right? So they're paying. The government's paying income, and then also tenant income. So you get double income. Because so the government wants the property to be functional so that they could tax it. So if the neighborhood's distressed, like okay, you flip one home, it's not going to change the whole neighborhood. So they go in, they purchase at scale and flip the whole neighborhood. Yeah.
But
So
then there's real estate, there's risk to.
there's risk because when we looked at the Federal Reserve report, right? Let's pull it back up. Federal Reserve. Oh, I have it right here. So last week, I like to, this is what we talked about last week. I like to bring it back up and just kind of give you some topics that if I tell you two weeks in a row, hopefully you learn something, right? I don't know, maybe. But they definitely talk about cap rates. So you asked me, is this group's investment model risky, right? Potentially. But there's an argument on their end because I actually spoke with one of the guys, right? I'm like, hey, cap rates are at all-time lows. Isn't it a little risky? And he was like, well, we're buying at rock bottom prices, man. So it makes sense because how low can 25K go, right? It's already at rock bottom. So that's essentially their strategy. But let me show you the Federal Reserve report that they mentioned. This is from last week, but I'm just going to pull up a quick stat to show you right here. So, and I'll zoom in too. Or I'll zoom in first. So if you look at this right here, this is from the central banks themselves, the people who print the money, okay? So that's why I put a lot of weight into this analysis. What they say on the left side right here, commercial real estate prices have broken out into new highs, right? So it's expensive, right? On the flip side, the cap rate in commercial real estate, cap rate is extremely important. It's at the bottom, at its all-time lows, around 6%. You won't get 6% here in Silicon Valley though. Remember I said you get over here, you get 3 to 4%. So the situation is kind of bad. But apparently this company, they say 8% is what they're returning, which is pretty good. So that's the risk that I'm seeing right now. Meaning if interest rates go up, cap rates will go up, right? And prices will go down. Inverse relationship. Same thing with homes, right? Interest rates go up, home prices will start to feel the pressure and they'll go down. But the hard part is I don't know how low. And that's why I rely on Mark Hansen over here to kind of give me his insights. And he feels 30% is a possibility. Now, that's extremely provocative to go out and tell people. So that's not something I'm going to go out and tell people. It's because people, okay, when I worked in private banking at Silicon Valley Bank, almost everyone's net worth is in their real estate. Like 90% of everyone in here, 90% of your net worth is in your real estate. Most likely. I'll say that with confidence because I've seen it firsthand.
Wait, so why do you not want to tell people about this?
There's legal reasons behind it because as a real estate agent, I'm kind of like promoting a sale, a transaction.
Yeah.
But yeah, I can't do that. That's illegal. So I have to disclose, right? This is, you guys know me. You guys come in here. You see my meetup. It has all these disclosures, all for educational purposes only, right? But I love the analysis because in the next super cycle, can you guess what I'll be doing? If I know the environment's right, I'm going to leverage up and start maybe developing homes or whatever, right? Like this gentleman that I met, he started developing in 2013 and he built phenomenal wealth. It's just another thing to have going in the background because I noticed that they work hard, right? I don't have experience, but it seems like they're able to balance developing a home and do other things, which I kind of like, right? So build up the real estate transaction business and develop homes on the side, and then if you got time, trade in the morning.
There's a lot of waiting process for this real estate.
Exactly. I've seen a guy who, he was going to college and he had 2 kids and he was barely making a living, but he had a house being flipped on the side. So if you could do all that, hey, I see the passive nature of it, right? So let's get back to what we were talking about. So now that I explained the curve and how important the curve is and how predictive the curve is, especially the bond yield curve, now we shift our view over to the volatility futures curve, right? Because the bond yield curve, it helps me predict what the bond prices want to do. If the bond prices want to go up, then interest rates want to go down. You see how important that is? So I leverage the bond market to tell me where interest rates wants to go. If you look at the most recent action in the bond market, it's telling me that this Wednesday, JC, I think central banks are gonna look. Bonds are going up right now, right? They think the bond market is speculating right now that interest rates are gonna stay the same or go down. Isn't that interesting? Like you see it in the price before the Federal Reserve even says anything. That's the beauty of analyzing right here. But a lot of people will never see that. So Yeah, so anyways, going back to it, besides, so that's why I look at the futures curve, the VIX futures curve, because I want to see where these volatility traders, investors, sophisticated investors are kind of predicting the S&P 500 will go next. And right now they're predicting down. So it just kind of makes sense to maybe start hedging. Hey, what's up, Santo? But yeah, any questions on the VIX?
What is the VX1, VX2,
Yeah. So remember how we looked at the ES and I thought it was 4 contracts, but apparently it's 6 contracts. I still think it's 4 contracts because I've seen the E-mini the S&P 500 futures curve before, and I only saw 4 nodes. So I think it's 4 contracts, but I have to double check. So in the VIX futures curve, there's 8 contracts. So each contract is 1 month out, 2 month out, 3 month out, 4 month out, 4 months out. So when you buy an options contract and you buy a 6-month contract, it expires in 6 months, right? This is the same thing because they're standardized. So these contracts are constantly expiring. They're going to expire. They're decaying assets. So they're purely speculative investments, or trading vehicles, not investments.
So, how was it would be in a normal case?
How would it be what?
In a normal case, in a
Oh,
normal bull
yeah.
market, what
You're
would
right.
it do?
Yeah, in a normal case, it'd be pointing down, like it'll just be going down like that, because it's telling me that the VIX wants to fall. Right now, it's predicting that the VIX wants to go up. So in a normal market, it'd be going down like this. And about 70% in a Federal Reserve printing money environment, 70 to 80% of the time it'll be going down. So you want to be a long trader. That's why it was until February 2018 when the markets pulled back really hard. Yeah.
Oh, this is how all this institutional like asset companies, if the market is down 40%, they'll be just down 8 or 10, 12%. They use all these instruments to hedge against that downturn, right?
So the industry is a lot more diverse and bigger than that. So there's like mutual funds, which manage consumer money, average Joe's money, which is pretty big. And then there's asset management firms who just manage cash for corporations or rich people. Let me explain that. So there's a major difference between, and it's news in a weird way, right? There's a difference between a mutual fund, which you guys all know, I'm hoping, or guessing, and then there's an asset management firm, right? They are the same in some definitions, but the main difference is asset management firms, they really just manage day-to-day cash. So for example, let's say you're a billionaire, and then there's also Apple. Because you're a billionaire, you have I don't know, let's say you're Jeff Bezos, you have 100 billion, or 80 billion, whatever, or Mark Zuckerberg. In that 80 billion, how much will you be in cash? Probably 1 billion, right? Out of the 89 in hard, illiquid assets, 1 billion will be in cash. So you need the services of an asset management company. And what they do is they'll take that 1 billion, they'll buy 3-month bonds and 6-month bonds and 1-year bonds, and they'll roll it over as you need it, right? Because we always want the money to be in contract for us to get some interest. There's a lot of interest on a billion. Hey, give me $1 billion, I'll roll it over for you, right? Every day I'll be buying the bonds and just roll it over, and that's my business. And that's what some of these asset management companies do. So it's a lot more broad than you think. And then on top of that, you have hedge funds. So the asset management company wouldn't care about these volatility futures because they're just in the business of like, what's the bond market doing? We need to roll it over every day. Right?
What about like George Soros? What?
George Soros is different. He now owns a family office. I think, well, I might be wrong, but he was a hedge fund manager. That's different. So that's something I might aspire, to be one of these days. Not now. I'm not of age yet, but
Yeah, I was actually watching a really interesting video in Chinese.
Yeah.
Talk about the Asian crisis in 1998. He was the one behind it actually. He was leading Morgan Stanley, a bunch of the companies doing that. So back then was a hedge fund manager in 1998.
Were there hedge fund managers?
Was he a hedge fund manager
I
back
think
in
he
1998? He changed his model, I think.
So let me tell you, he's a global macro hedge fund manager. So there's different strategies. You could have a momentum hedge fund manager. You could have a event-driven hedge fund manager, a global macro. Event-driven is like, okay, VMware and Dell are gonna, or Red Hat is gonna get bought out by IBM. So you short IBM and then you go long Red Hat because one's gonna expense and one's gonna gain, right? So that would be like an arbitrage, event-driven type of trade. That would be like another form of money manager. One is like, oh, event-driven would be like a pending legal activity where once this, this thing goes down, someone's gonna get hurt really, one company's gonna get damaged and the other one's gonna benefit. So that's another one. Global macro is what we've been talking about as of late. As interest rates rise and all the other economy starts to drop, there's gonna be huge bets in like gold. So I think he'd be looking at gold but I think he's more of an economy global macro guy. So he's more focused on like currencies because currencies are big and liquid. Testing. Okay, I thought I was going to echo. So, but where was I going with your question? So there's many different firms out there, but let me give you the way a hedge fund manager thinks. Okay, before this investment club came first, and then I became a realtor because I was assessing the economics of the world, and what I saw was there's a lot of equity built up in the real estate market from money printing, and so it's going to get to a point where people need to start selling, and so that's why I transitioned myself into this position. So that when that demand starts coming in to sell, I want to maybe capture some. You see what I mean? I'm constantly assessing the economics. And something I realized recently is, I don't know if Santo, if you could agree with this, but the overcapacity in cloud development. Is that true? Is that a possibility? So there's overcapacity in semiconductors for sure. The head of IC Insights, basically this guy's like a leading thought leader in the semiconductor segment. He said in his own words that this is the largest overbuild I've ever seen. And that's why we could justify this 48% minus on NVIDIA. And I think NVIDIA could go down to like 80, 90%. Because every recession, NVIDIA dropped 80, 90%. So if you know that, let's wait for a 90% drop and then we'll consider some positions, which is kind of nice. But I never thought about cloud overcapacity. Is that a possibility? Is it possible to have too much data center commercial real estate, too much software related to data center, or too much computing related to data centers? Would you say?
I'm not seeing it.
You're not seeing it? Okay. So yeah, some analysts feel that there might be an overcapacity for data center or cloud stuff, cloud related stuff. But for sure there's overcapacity for semiconductors is what they're saying. So for now, if you want to track the semiconductors, that would be, SK said that would be around 2025. So in that sense, MongoDB is pretty bullish if you look at the charts right now. So I think that's still a good trade.
Yeah, actually, if you look at the software ETFs, like XSW, for example, they haven't dropped as much.
X what?
XSW. Or you look at, what is it, IGV. The pure software plays haven't dropped as much.
Yeah. Dude, that's my go-to. That's, I would aspire to be a money manager or a hedge fund manager, but I think another exciting realm is to become a private equity software company. So I'll flip software companies. That would be awesome.
I'm sorry.
Yeah.
Difference between asset management and private equity.
Oh, okay.
Venture capital fund.
Yeah. So private equity is a umbrella term, but in the industry they use it in a very interesting way. So private equity is PE, right? But within PE, you could categorize it as VC, leverage buyout, etc. But people the way they use the word, it's like PE or VC. Right? Are you in PE or are you VC? And that's just a way to show that, okay, one focuses on businesses that already have cash flow. It's already making money, and you just re-engineer the financials a little bit. Right? You go in there, you restructure sales and marketing, operations or whatever, and then you flip it. VC is purely going from 0 to 1, Peter Thiel would say. Meaning this market doesn't exist, like the iPad never existed. We're going 0 to 1. We're going, very early stage.
Even though
but that's where you buy more equity. PE is more typical with leverage buyout. You buy an entire thing. So example will be like Marketo, who got sold to Adobe for 4.7 billion. So they bought Marketo for 1.7 billion, re-engineered it for a few years, sold it for 4.7 and made 3 billion. Man, that's insane.
PE also invests in early stage.
Yes, so they could lend. There's two forms of investing. You could lend, the debt side and the equity side. You could purchase equity or you could lend. Silicon Valley Bank is known to be a lender in venture capital.
Okay.
Yeah, that's why I learned when I worked there. I learned that, wow, these guys are really servicing the VC ecosystem. When you buy Silicon Valley Bank, the stock, you're buying like a venture capital focus, like, ecosystem where all the fees are coming from the VCs. Their clientele, man, I saw their clientele. And the biggest one I always tell you guys is the 2 billion, the guy who owns 2 billion. You guys all know him, I just can't tell you who he is. He or she is. right? So when I saw the structure of that person's balance sheet, when you pass a certain amount of net worth, so I'll tell you one more time. There's this many millionaires, right? From 1 to 5 million, there's this many. And then once you go to like 5 to 15, or 5 to 20, there's about this much. And then once you go to like 50 million and up, there's about this much. And then once you go to 100 million and up, it's like a handful. And then billionaires, I only saw 2.
In Silicon Valley,
In their database, at least. I mean, but if you, I mean, you know, like statistics, right? They like to take samples. I think that sample, at least from what I saw from their complete database, is a good, you know, idea of what the real population looks like, right? I only saw 2 billionaires and about 500 millionaires. So, man, if I had a dream, it'd be nice to be 100 million, because I'd be like, oh man, I'm a handful. But yeah, so that's the difference between private equity and venture capital.
So on that note, Silicon Valley Bank is at 52-week low. What do you think of the stock right now? I mean,
it's crazy. I mean, it's like I said, Santo, if you notice the last 3, 4, 5, 6 meetups, we've been talking a lot about global macro. It's just, right now you have to be an active trader, investor. You can bottom pick, but right now it looks like the best dip buying opportunity ever. At the same time, it looks like a global recession. So there's two, yeah, you could, I think a bounce is coming though, right? If you know, was it Tom Lee?
But you still like Silicon Valley Bank?
I still do. The fundamentals are good. It's just in a global macro environment, when indices pull back, everything else will pull back. So, I mean, there aren't that.
It's gone from 330 to 190.
I know, and it's a strong company, high gross margin, and they own a nice ecosystem, and they have global presence too. And when I worked there, keep in mind I worked at a lot of companies, right? And well, I quit, and you know, I traded my employment quite a bit. And what I noticed is that they have a world-class management organization. Like, never did I feel so like, wow, this is a true leadership. And so, yeah, it's just like they got. I like the way they operate.
So I'm sorry, I mean,
Yeah.
I come here. Last time was your first time here.
Yeah.
So what about Warren Buffett and Benjamin Graham? Are those asset manager too, or no?
So they're investment companies.
Investment
They're not a hedge fund manager because they don't short.
They don't short.
sell.
Okay,
Yeah.
okay.
To me, I think of hedge fund managers as assessing the economics of a situation, right? And in that economics, you could bet in 2 different ways. You could make money because one side will benefit, the other will lose, typically. If you notice in economics, they say there's no such thing as a free lunch. Nothing in this world is free. Like, you want the reputation, you got to put in the effort and go build it. You want the wealth, you really have to go build it, right? Like, there's also other pictures of like talkers, and then there's like a huge amount of talkers or critics, and then a small amount of talkers, and then only like a few doers. It's kind of like that, if that makes sense.
What about certain trading people in the Eastern firm? Like, do they certain trading people use? I don't know. Like in like a Morgan Stanley or Goldman Sachs, there's certain trading department.
Yeah,
What
yeah.
do they do exactly?
Yeah. Yeah.
So,
Wait. You're asking what is
like,
Goldman Stanley?
Like Morgan Stanley and also maybe other like Goldman Sachs, they all have a certain trading arm.
Yeah.
People work there. So do they like, do they speculate, do they hedge, or do they?
So lucky for you, I saw the insides of Morgan Stanley. They're about, for the most part, last time I checked, 40-50% wealth management, right? So that you have to understand each entity or organization has a portfolio of products. So one portfolio of product they supply is wealth management, and that's about 40%. When you're talking about when they're trading on the inside, they're mostly doing prime brokerage. They're doing something called agency trading. You guys have to understand that when you come in here and we talk about investing, you guys are really proprietary investors or proprietary traders versus agency traders. You know, the difference between that is I could be a proprietary real estate investor or a real estate agent. That's the difference. So proprietary trader, you're trading for your account, your money, and that's what we're doing in here, right? As a club. But as a agency trader, you're trading for, I don't know, George Soros has an account with Goldman Sachs, and he wants to make $100 million trade through the prime brokerage. The sales and trading analyst or associate in Goldman Sachs will be like, "You got it, George," and then place that 100 million trade with their proprietary software. That's what they do. I think they removed the proprietary arm. After 2008, they regulated investment banks. So investment banks are not as lucrative to be at. It doesn't make sense to be within. So I learned it the hard way because I got the licenses and all that, right? And what I learned was like, they don't do any proprietary stuff that much anymore because of regulation. It's better to go out on your own and start your own hedge fund or private equity fund and not have any regulation. So that's why I love operating like this. I'm like so much more free. I could talk how I want to talk. But if I was at Morgan Stanley, they'd be like, "No, you can't say that." So they don't really do what you think they do. They do. So this is their portfolio for the trading aspect. Are you guys okay with this topic so far, or you want to hop back on track with where I see the opportunities? Okay, all right, let's go. All right, sorry. So you guys got all quiet. So one gentleman left. So let's jump back to the opportunity. So let's complete that with the volatility or the VIX, and then we'll move on to something else. Okay. So for opportunities, I see long volatility as an opportunity. If you look at the VIX index, it looks like it wants to break out and go higher right here. And so you can't trade the index, right? So some ETFs would be UVXY. I think this one is going to go up higher, just from the analysis of TA on S&P 500 and QA, quantitative analysis on volatility futures, right? Difference between TA and QA, one is just one on steroids. Technical analysis is more like discretionary. Quantitative analysis is more like you're getting down to like using a computer and really quantifying every movement, right? So I did do a QA analysis, if that kind of, I mean, if you ask me, this is basically QA. Like this is not standard technical analysis. This is quantitative analysis right here. When you have like your own analytics dashboard. But anyways, UVIXY is an opportunity. TVIX is also an opportunity. So the gentleman who was in here, he's probably long these positions. Now, educational purposes only, right? Other opportunities. Well, thing to note is S&P 500 breaking down 10% from the 10% drawdown. So right here I have the S&P 500, right? We've been hanging out at the 10% for some time, and we're finally below that. I think we're going to go down to like a 15% drawdown. So portfolios, right? I know a lot of people in their 401ks, they're down like 10, 15%, right? Thousands and thousands of dollars. I feel like whatever happens this Wednesday with central banks, Federal Reserve, if they don't do anything, I think it could go down to 15%. And it's going to be a lot more painful, I feel. You feel the same, or yeah, at this point, or you kind of?
You know, I also feel all this uncertainty about Trump and all of the, the macro situation.
Yeah.
If you start seeing rumblings of impeachment, I think it will just collapse.
Yeah. So.
I'm going to post a picture of S&P 500 chart with the VIX.
Okay.
And last 4 years, you kind of see how they correlate to each other.
Okay. Real quick, let me show this to Santo. So what I have here is the. You weren't here last week, but Financial Stability Report for central banks. They themselves issued it November 8, 2018. I highly recommend the read, but it's kind of long. But I just want to show these are the other short-term risks that the central banks feel are an issue to the financial system. Number one being Brexit and Euro area fiscal challenges pose risk to U.S. markets and institutions. That's one. Two would be China and other emerging economies could spill over to the United States. Though we did that to ourselves by raising interest rates. When we raise interest rates, we destroy the emerging markets. So that spillover is our own doing. It's the snake eating its tail. All right? And then number three, trade tensions, geopolitical uncertainty. So what Trump's doing, right? I mean, but at the same time, if you truly understand the system, which I kind of feel like I have a decent understanding now, it's getting messed up. The system is just, it's breaking down because of money printing, right? And this, if you read history, like Jim Rogers, he's big on like, every economy just eventually devalues their currency to promote transactions. Because, dude, we got to play this Monopoly game again, right? As long as you keep playing the Monopoly game, and then I start juicing the economy, the game, and the money spreads, at some point, it's going to go to the best players. And in the next printing, it won't work anymore because that money keeps going to the best players because they have inflated assets that even appreciate more. Because I'm trying to help the 1%, or I'm sorry, the 99, 90, whatever percent. So I see what they're doing. It's not an easy game. I wouldn't want to be on that side. But anyways, JC had a chart right here, so I want to pull it
To
up.
go over the chart, what I did basically, this is what happens, and this is what we discovered in the last 4 years with the VIX underneath it. And this is what happens in a bullish market if you were to go, on a higher bullish run. So if you look at the blue boxes, what I did is that anytime the S&P 500 is above this 20 MA on the first, all the way on the left, the first blue box, back in 2015.
Oh, this one?
Yeah. So if you're above the 20 MA, which is the perforated green line, if you scroll down, the VIX is going to be below 20. If you scroll down a little bit, have the VIX below it. A little bit lower. If you scroll down a little lower.
Oh, my bad. Okay, sorry.
So the VIX is basically, if we're above the 20 MA, the VIX is going to hang around below 20, right around 16, 15, 17, right around there. As soon as we drop below the 20 MA or the 50 MA, the VIX skyrockets above 20, around to 28, right? Every time we go below the 20 MA or 50 MA. Then if we stay below there, it's going to stay around 20, 27. And then as soon as you go back up to 20 MA again, it's going to drop below 20, 15, 14, 15, so forth. So net what's going on right now, we already went below the 50 MA, and that's what we're hanging around 21 on the VIX.
Yeah.
So if we see the S&P go down to the 200 MA, which is the red line, you're going to see the VIX go to 28, 35, right?
Yeah,
Around
yeah.
20. And of course, if we see the S&P go up above the 20 MA, it's going to drop under 20 to 19 or 18.
Yeah.
So it's just, that's why it goes with the S&P wherever it goes.
Yeah.
And that's what
So this is exactly a similar way of like, I'm looking at the S&P 500 over here, and then I'm looking at the VIX. I do the same thing. But now, at the same time, I'm looking at the VIX futures over here. So I'm looking at derivatives of the VIX.
Can you summarize this one?
So basically, what I'm saying, if you see the price action on S&P 500 stay below this 50 MA, the blue line, below there, and it continues to go lower.
Okay.
Which is
the
right
VIX,
here.
If it goes down to the 200 MA, which is like 2,300, the VIX is going to skyrocket to 35, 40.
Yeah.
Right now, if S&P makes a comeback and gets above the 50 MA and it gets above the 20 MA, the VIX is going to drop to like 16, 17. So that's why it correlates with S&P so much. If the S&P drops, the VIX skyrockets. If the S&P goes higher, then the VIX grows.
Yeah. So I feel the opportunity. So that's the first opportunity I see in the market, which is long volatility, right? Which is going long. Some things like ETFs like UVXY and TVIX. Now, caution, because these securities have a huge range. So if you're going to trade them, okay, you got to know like your position sizing. But that's where I see the opportunity. I think volatility is going to spike. Also depending on what's going to happen on Wednesday. The next opportunity I see is actually emerging markets. It's but not now. I don't see it now. Maybe give it another few months. But emerging markets, Chinese stocks, Russian stocks, Indian stocks, Brazil stocks, they got beat down so hard, right? So if the U.S. is going to go down, here's a perfect example of what happened in 2008. So what I have right here is so the blue one is the emerging market line, and then the red one is the dollar line. Because every time we raise interest rates or we work with the interest rates, it'll fluctuate the dollar. So this is what happened in 2008. In 2008, we raised interest rates, the dollar went up, right? And then at the same time, emerging markets went down. But as we lower interest rates and then the dollar value itself goes down, emerging markets rallies like crazy. So what I'm seeing right here is the same thing, right? Emerging markets are going down because the dollar is rallying right here. I don't know if you guys see that in the back, but it went down. So I think this is nice because the moment things turn around and we start lowering interest rates again, they're going to deleverage. Okay, what's the logic on emerging markets? They borrow money on the dollar, and then it's also about the inflows of the currency. Because if the dollar is more attractive with higher interest rates, it will leave the EM. So that's kind of considered bearish. But yeah, I think there's going to be a massive rally in emerging markets in the coming. Oh man, I can't even time this one. You just gotta keep watching because the dollar right now looks like it's going to keep going up, and if it keeps going up, EM's going to keep going down. So opportunities for like Alibaba, Tencent, SoftBank, man, those are great companies, but just gotta be patient. That's one area where I see major opportunity. There's more blood to come in the EM. See, so dollar hasn't peaked yet. So Darsh, I agree with you. I 100% agree with you. I like Chinese stocks too. I thought that one Wednesday when the central bank said that they're dovish, and then EM's rally and dollar kind of goes down, and S&P 500 rallied like crazy. I thought like, hey, this might be the turnaround, but no, there's still a lot of fear, and I think this fear will also bleed down to other markets, right? Because in the, going back to the financial reserve report, just one nugget I'm going to share because Santo's here as well. Wanted to show you guys this. They feel that asset prices are overvalued. And I'm just going to show you which asset prices are, what are the values of the asset prices. So, right here. So this is the number one, chapter 1 of their report. Overall asset valuations and risk appetites are elevated. And within that, they feel that equities, or they see that equities is the biggest. So stocks are the biggest. So if they say they feel assets are overvalued, number 1 is stocks, number 2 is residential real estate, and then number 3 is commercial real estate. Kind of insane, right? But yeah, so that's why I feel EM would be a great play moving into the next super cycle. So keep on the lookout for that. I guess for time's sake, I probably won't read into this because this is basically getting into the explanation as to why EM would rally. But did you guys want to hear the explanation, or?
I guess I still want to understand the correlation between the interest rate, US dollar, and why would that affect
Okay,
the
okay.
market?
Okay, so in your head, you have to eliminate all asset class right now, and the only thing you need to think about in your head is currencies or countries. Better yet, it's simpler to think of it as countries, and there's the way each country manipulates their interest rates makes it attractive. So just in this room, just think of countries: America, Europe, Japan. If the U.S. lowers their interest rates, then it makes the dollar less attractive. So people would sell the dollar. But if they raise the interest rates, then they want to start buying the dollar.
Okay.
So as they buy, so the money is leaving emerging markets and going to the U.S. Right? So that's one bearish part. The other one is the expense ratio of emerging markets go up because now they have to pay higher interest, and they also leverage on the dollar. Right? Let's say they got funding from the dollar. So typically, at least the market tells you, the market teaches me a lot, that when the dollar rallies, because interest rates are probably higher, right? And when there's those important divergences from the standard mechanical system, then I have to ask, like, what's wrong in this system, right? So that's why I see the case for EM. So that's the relationship. That's the explanation. I don't know if that was good enough.
No, I got it.
Okay. So that's why I see opportunity in that. So let's say 401k, depending on how you are allocating it now, man, I started allocating cash or short-term investments, like those money market funds that the 401k offers for you. So I started plowing into that one, just because I don't know right now, right? And it's getting negative because you guys know Leon Cooperman. I watched the Real Vision recently. I'll skip ahead a little bit around the opportunities that I see. But Leon is this gentleman right here. He's I think he's worth about 3 billion or 2.3 billion. So I sat and I listened to this gentleman's Real Vision conversation, and this is what he said. So this is one headline, not from Real Vision, but Leon Cooperman, the hedge fund billionaire, says it's time to fold them, right? And in that discussion or video, the Real Vision interview, this is what he said. It was recorded on November 7th, right? So pretty recent. He said, that influenced my decision to return the investors their money. So he's closing down his hedge fund, right? And this guy has a track record, like 30 years of being a hedge fund manager. I think we're getting closer, is what he said. So I want to go out on top. I don't want to be 76 or 77 years old, feeling I'm obligated to remain in business because I'm down and got to make back that loss for investors. So I'm going out now to avoid that. So this is, like, to me, one of the bear market symptoms I'm seeing when big, credible money managers who manage a lot of money decide to exit their participation in collecting client money. So I don't know. What do you guys think? This is actually like the first time for me seeing Apple and stuff down like 20+%.
If you look at 2016, Amazon was like 800. 2015, 2016 was 800, and today it's still 1,600. So it's down from its peak, but it's not to any of the same levels that we used to see. Right? A lot of investors have poured in money from everywhere else, from probably utility companies and energy companies, and put it in this big tech stocks.
Yeah. So
they're not still down, down from last 1 year's gains they have lost, 2 years gains they have lost. That's it, right?
Yeah.
But one quick thing, I keep saying it over and over, so whatever the S&P 500 does, all the other companies are gonna do the same thing. If it's a month later, a month earlier, they're all gonna do it. So the S&P right now is down like 11%. Every other company is gonna down 11%, 15, 20, 30, like Nvidia, 40%. It doesn't matter what company it is. I don't care if they have the best technology in the world. It doesn't matter. Whatever the S&P does, everybody's gonna do it. And you can put any stock you can give me. You can put S&P with that stock, and every time S&P drops a lot, they're gonna drop a lot.
So
My point is S&P is the train, and everything else is a carriage in that train.
yeah.
So it doesn't matter.
So in the next, not this segment, but the next segment, we're going to talk about stocks, and I'm going to show you stocks that are really fighting this trend, right? So we're in a very, I could say, initial bear market, but there are stocks that are fighting this bear market. MongoDB being one of them. So what does that tell me? I love this divergence right here, because the moment the market, repairs itself, these stocks are. This is where when the tsunami hits, because of the tsunami, the treasures reveal itself, and I'm going to show you what I found. Right? MongoDB is one of them. So I think in a market recovery, MongoDB and Twilio, another one, is going to be strong players. It makes sense. Salesforce has 1% interest in Twilio. But anyways, another opportunity I see is the global macro opportunity, right? Because this is George Soros' environment now, or whoever is a global macro money manager. Long the dollar. Jim Rogers is long the dollar. He explained it pretty well. I'm kind of aligned with his thinking. If the Fed still have plans to raise rates, then this midterm dollar bounce will continue, in my opinion. Other opportunities in global macro is, again, I said it last time when we looked at some gold stocks, long gold, but I'm more long gold miners, right? And the gold miners that I'm long, if you guys recall, you guys want to see the gold portfolio again? This is the gold portfolio that I'm looking at going long. I have some calls on it, but I don't normally purchase 2-year calls. But I purchased 2-year calls on some of them because they're so cheap, right? So I'll show you. So this
Miners have been going up since the time you've been talking about.
Miners?
Yeah.
Yeah. Of course, man. I hope I'm right, man. Yeah. So this is the one right here. So this is my well, not right now. I guess it's down as of the most recent trading action, right? But we open this in Screener. We look at the performance in the past quarter. Not bad. Some of them went up like 35%, like these right here. But I'm going to arrange this by market cap, right? Because that's how I typically prefer to look at it. So my number one is actually, the one I like the most is actually GG. And then my second one is KL, right? Now, you guys want to know why I like gold, or you understand that already? Gold, because the moment they raise interest rates, they damage the system. They have to go back to lowering interest rates. And they lower interest rates, and they're, again, damaging the system. And so big money managers are like, well, we need a real fixed asset. So gold apparently is that alternative currency. This also makes a great argument for cryptocurrency. And I have a report at the end that I plan to read. I haven't read it yet. But if you guys remember 2016 and 2017, I read the report to you guys, In Gold We Trust. You guys remember that? Or JC, you remember that?
Yes.
So the report was like 200 pages. So I read both those reports. So that's like about 500 pages. But it's awesome. I highly recommend it. These guys got into a conversation with another money manager and put the report together. I'll show you right here, if I have it. Basically, they're in the discussion. They talk about reasons to go long Bitcoin. So I'll share that report with you as well. But just a little teaser. Let's see. This person said that when it comes to talent, it's completely upside down because the 20 to 25-year-olds have to explain the technology to the senior guys. These young people see opportunities and they want to disrupt industries, which is a very different mindset compared to traditional finance and asset management. People who complain about margins getting lower, regulation being tough, etc. Therefore, not only is there financial capital coming in the world, but also human resources, which make us confident for the future. So this is the report right here. So I probably read this and then go over it next week if you guys want to hear about blockchain, because I know there's some interest around that, but in the current bear market we're having in Bitcoin, no one really wants to talk about that. I want to talk about that.
One thing that I don't understand about Bitcoin is it never stops anybody from offering their own new coins, right? It's new sovereign coins, it's about people adopting it.
Yeah, yeah.
That's what we are really dependent on, not
Yeah.
on anything else,
Yeah.
other than
Like-
people depending on it.
Yep, like every software, every platform software, it's all about number of users,
Right?
end users. That's all it is. Yeah.
So-
Same. Now, believe it or not, use that same thinking and apply it to the dollar. Every sovereign cares about user adoption.
No, I mean, dollar is, as long as we have everything, international contracts are being done in dollar terms. Like
Yeah.
For example, when she was talking about emerging market, when we can't get loans below 10% in India, but if we borrow from America, we get loans at 3, 4, 5%
Yeah.
for big companies. So
Yeah.
adoption is there for dollar. There is no hiding place from dollar.
Yeah.
There is no alternative
Yeah.
to dollar.
Gold. So for
Gold,
money,
yeah.
because they print the dollar,
Right,
right? How do you hide from printing of the dollar?
right.
That's the issue, right? Your purchasing power went down.
Right.
So to hide from the dollar, you jump to stocks. So by nature, you have to move around. You can't stay, in dollar only, because the moment they print, you got to jump out to like real estate, and that appreciates. Then you jump back to the dollar. But now the super cycle is reversed. So that's why I'm seeing record. Man, there's some smart people putting like listings on the market.
The US dollar is the currency of the world, right?
Yep, yep.
75% of all funds go through US dollar.
Yep.
And then you've got the US military behind it, all of that stuff. So US dollar and comparing that to Bitcoin is just because Bitcoin got nothing back in it. Bitcoin has supposed to be 21 million total tokens, and then they start splitting up with their hard fork and Bitcoin Cash, and they get another 20 million. So it's not really 21 million, all this fork. So to me, Bitcoin is not going to survive.
So I want to teach you guys 2 new concepts today. Well, actually, I think it's 1, if I recall. But if you guys look at the dollar, right, and this is a repeat, the dollar is still in a bull market, right? If you perform technical analysis on this, and I think Chris wants to see this, so I'll perform a quick technical analysis. When we're looking at the monthly chart on gold, right, and you can also see that right here. What I'm seeing is there's this major trend right here, and it broke right here, right? And then I'm seeing a rounding bottom, or at least a lot of support around 1200. So to me, I see a lot of accumulation, and I think it's still in a bull market. It didn't retrace, it didn't go all the way down. And it makes sense because if I kind of back test this and look at maybe 2000, right? What happened here, it kind of broke out and rallied. And if you look at 2008, this is 2008. So every time they mess with the dollar supply, which they will in every major economic, global recession or whatever, I think gold is it's building up. I don't see gold. It's very hard for me to see gold going down below 1,000, just because of the going economics. And in this past year, if you guys remember, in Gold We Trust, we talked about last week, the biggest accumulator this year has been China and Russia, right? But they're not the biggest holders of gold. The USA has the most gold, right? And it will continue to serve as that leverage or that power to, get people to use your currency.
What did you mean when you said that you saw some accumulation? Are you looking at volume, or are you just looking at how it's...
Sorry, yeah. So in Gold We Trust report I showed you last week,
Yeah.
the biggest accumulators are China and Russia,
Oh, okay.
right? But
I thought you meant accumulation.
yeah, not from here. From just a quick technical analysis, I just showed you that I see very strong accumulation support at 1200, right? And then I also see a rounding bottom, which is another support type of
So
analysis.
like when it gets down to like
Yeah.
100, people start buying it.
Yeah,
You-
yeah.
That's accumulation coming out.
Yeah, so I think gold, now, I wanted to teach you guys a new concept today because I learned about it. We were talking about, I forget her name, she comes in here quite a bit. I think it was Sarah. She asked me like, why gold miners compared to gold,
Yeah.
right? Oh, you want to know that too? Okay, so good. Yeah, so it has to do with leverage or undervalued nature. Gold is cheap, people would say right now, relative to its previous secular bull market. But they say gold miners are even cheaper, right? And so it was hard to explain when I said that, but there's actually an actual index that you could look at. It's called the HUI Gold Index. And what that is just basically an index showing gold miners over gold, right? So the lower the number, the cheaper gold miners are.
And I also put up the chart of both of them right next to each other.
Oh, you did?
The last week.
Oh, okay, you did.
Leverage was obvious with that.
Yeah. So the explanation, the answer is gold miners are a lot cheaper than gold, even though gold is cheap. So that means essentially they're more leveraged. So in an upswing, think about it. We talk about how, again, Gold miners had 6 years from 2012 to now to re-engineer their balance sheet, their income statement. So they're efficient. Their cost. What do you do when you're tight on money? You eat less, you go out less, right? That's what they did for 6 years. And now that if gold starts going up, they're going to be good at capturing it. So again, I use the example of if you sell every $100 per unit, and you're making your margins, your expense margin is 90%, you're making $10. What happens when that $100 goes to $200? Now you're making 110. So that's the bullish investment thesis for gold miners, right? That and also sovereign distress, right? Economic distress, money printing, and destroying of the monetary system around the world, right? Every economy is destroying their money to juice the economy. So, and the other argument too is gold has been man's 6,000 year obsession. We fought and died for gold, so for 6,000 years. Now we don't fight for it, we trade it. But yeah, so that's my my bullish case for gold. So I'm still bullish. It's not like a short day trade, right? So that's not what we're talking about. But did you guys find this interesting? This was a new concept for me. I didn't know there was an actual index to really gauge. So okay, go into the index, right? So this is the actual index. So I told you that gold miners are cheap relative to gold, but we don't know how cheap, right? So this index does a good job of showing you how cheap. So actually back in 2015, it was the cheapest ever, right? So now it's not as cheap. If that did you guys understand that? In 2015, gold miners were cheaper relative to gold. So this is that equation: gold miners over gold, right? So I guess one could apply technical analysis on this, on an HUI index, and start buying gold miners, right? Another way to do it is to look at GDX. GDX is the ETF for gold miners. Because if you don't know which one to pick, then you could just buy an industry, GDX. That's a simple way to kind of diversify your money. Again, educational purposes only, because I see you guys writing down. I don't want you to come back and be like come back with a bat and be like, this guy was wrong. And so yeah, keep in mind, this is a educational alternative investment club.
So we might also bring you some cash bonus if we make
Okay, well hey.
Remember last year?
Yeah, it's been a while. So this investment club's been running for,
If that's the
believe it or
case,
not.
he's gonna need a new office then.
Yeah. If this investment, so the Milpitas library was not big enough. It'd be kind of cramped for everyone here. I mean, it'll probably still fit, but believe it or not, today's number 98. And I started. The idea came upon me in November 2015, I think, and then I started in 2016. If that sounds right. And yeah, and now I do this like every week because when I wasn't doing it for like the last 2 weeks, I had nothing else to do except reading like trading books and stuff. Or reading trading books, listening to Real Vision, and just looking at markets. It gets really dry when you do it alone. So I'm thankful for this club because it's like it brings in different minds. And the sponsor that I mentioned, right? You meet a lot of people. So I encourage everyone to go out there and start a community something that you're interested in. Because I hope like you guys are coming here because you want to because you're currently interested in it, right? Because if you think about the world right now, there's a lot of communities going on with different interests, right? Some people might want to be snowboarding right now. Some people might want to learn about cooking. So I started this because I always want to talk about investing. Yeah. Anyways, so that's GDX. If you guys are just lazy and you just want to look at an ETF, recap. Okay, I already talked about that. So let's get into the big tech names, and then we'll get into the true opportunities, and then we'll close it out, right? So this is something to be aware of, right? Short to midterm, I do see a short to midterm trade in major tech companies, right? You got to really look at the numbers here. This is a moment where the stars are aligned, and you got technical swing traders, day traders, and fundamental investors who are all thinking the same thing, right? Because the question is, do you trust the market? Are we gonna let Apple go down 30% and no one's gonna get there, drool a little bit? So I think there's gonna be a massive rally, because I don't think this bear market is gonna complete until maybe second half of 2019. So if you're waiting for home prices to go down or anything like that, or asset prices to go down, I think it has a process still. And this thing can still go up depending on what central banks decide to do, right? Because there's so much money in the system now compared to before. But that money always allocates to the best players or the capitalists, right? So how do you become a capitalist? Maybe you start an investment club, I don't know. Or learn more about investing. So short to midterm dip buying opportunities in tech names. These are major tech companies with percentage declines I've never seen before. So, or at least for a while. So Apple, look at this, minus 28% from the top. Amazon, right? Just so that you believe me, I show you the actual chart. From the top, minus 22%. Okay, that's Amazon. Facebook, man, I've been trying to go along this. It's finally broken above the 20-day moving average, but now it's having resistance at the 50-day moving average on Facebook. It's at 33, 34%. Right? Remember, like the institutional money manager, minus 20% off an index as a bear market. We're only 10%, so this could still go to a 15% correction. Right? We could still rally off 15%, which would be insane. I don't even know what to say at that point. Facebook, so Netflix. Did you guys know Netflix is down 35, 36%? Just percentage-wise, right? Because this is when fundamental investors jump in. They wait for these type of opportunities. Google down 22%, right? These are some solid businesses. So I think there's more. I just didn't name them, like Salesforce and Microsoft. Dude, okay, Microsoft is only down 7-8%. So Microsoft to me is world class. It's number one at this point, right? For like the longest time, for like 2 years, I think we were looking at Apple as the number one biggest company in the world. If you want to revisit that list, number one right now is Microsoft, right there. I was bullish on this one for a while, but in this environment, momentum trading doesn't work. You got a comment?
Yeah.
These are the by the way, these are the biggest companies in the world down, right? So Microsoft's number one. Yeah.
I think. Okay. What are the factors affecting the drop in the stock price in general? I know that percentage are owned by institutional investors, and they play a big role probably.
Yeah.
A big chunk of that percent, stock. What are, in general, what are the?
So I've been saying for like the past maybe 6 meetups, interest rates. Interest rates going up causes the dollar to go up. If interest rates go up, then corporate expenses, your interest expense ratio goes up. So corporations have more expense now. But at the same time, if they're international like Microsoft or Apple or SAP, the dollar also went up. So it's hurting their transactions. So forecasting earnings or revenue is going to go down. If revenue goes down, then earnings are going to go down, right? And at the same time, interest rates keep going up. And then so there's fear around the world. Then they jump to the dollar. So the dollar keeps appreciating and interest rates are going up. So this pressure keeps going up, right? So if you're a corporation, you bought back your own shares, you're over leveraged, right? That's what the central bank said. Corporations are over leveraged. Now your interest expense went up on all those factors. There's still more, right? And you got all these projects. You want to hire more employees like Apple. Well, can you fund these employees who now are workers or average people who want to go buy homes? But the homes are, interest rates are going up. So home prices are kind of going down, but it's harder for the borrower, right? Especially right now at the inflection point. So this whole system is kind of based off of that.
Just the main factor. That's the main factor is interest rate.
No. Just the lending interest rates. Everything is based off of lending.
No, I'm talking about this. Yeah.
I'm talking about interest rates of the bond market.
Right.
That's why we look at the bond markets.
Right, but like this drive, the major drive is the interest rate.
Yeah. So again, like if that expense goes up, then corporations, do you think they'll hire more or hire less? If they're already leveraged, they're fully leveraged, and their interest expense ratio goes up, and their share buybacks are against them in their position, right? Yelp they bought average at 40, now it's at 35. Yelp is underwater, right? So you might cut back on hiring. If you cut back on hiring, you cut back on people equipped to borrow money for homes or investments. This whole cycle is like, it's tied to that. Is what I see. Is that a fair statement, JC? Or?
One thing I wanted to add is like everybody always asks like what is the determining factor to the market? What's making it move, right? And what is making it move is a whole bunch of different things. There's like 10 things happening all at once, and then basically everybody, millions of people vote on what they think is important. But like the Federal Reserve is one of the big ones. Maybe that's like 10% of all movement, because whatever decisions they make affects everybody. Another one's going to be the trade war with China, right? Any kind of movement, they're going to move it. That's 10% of it. Another one is the Mueller investigation. What's going to come out? Everybody's firing about that. Another one's earnings, right? So they want to do the earnings, Europe. So all of them is that little chunk, 10%, 5%.
like this, investment, the big investment players, they would, like, they have money, right? If the interest rate go up, and they don't, they will not put money as much in those big companies we talked about already, they will put money somewhere else. That could be affected by other factors that.
Yeah, so there's a lot of factors affecting not just one thing, but you're right, there's certain things more important than others, like the Federal Reserve is a big one. The China tariff is a big one, those kind of, and then some little things are not as big as others, so it's just everything, it's not just one thing, it's a relation of many factors.
I found the answer at the sovereign layer. I found the answer at the upper end of the layer. So I hate to overdraw this, but at the bottom is average Joe, right? Above average Joe transactions would be SMB, small businesses like a cafe or a restaurant, and then mid-market would be like a startup, and then enterprise is at the top, like Apple, Facebook, Google, and then at the highest would be sovereign, right? So I see this stress at the sovereign layer, meaning if I were to draw another pyramid over here, because let's say if I'm doing deals, right? Am I selling software between enterprises, or am I doing real estate deals between average Joe, right? So right now I'm seeing the stress at this sovereign layer where interest rates are going up and it's causing every other sovereign to respond to it, especially emerging markets. They're like, ow, US is hurting us, right? Does that kind of answer your question? So it has everything to do with, interest rates is kind of like the motivating factor of how currency moves, right? But we as average Joes, we only think of it as like, oh, I go to Thailand and I'll transfer $5,000 into the baht, right, the Thai baht. But for the sovereigns, they're thinking about like major commodities moving around and currency reserves, and it's a big game. And I see the issue at that level. So if there's an issue at that level, it's trickle down economics, I feel. So that's why we've been talking about for the past 6 weeks, probably. Yeah. So stock opportunities I see, these are powerful stocks that I think will rally if the markets will rally. MongoDB, right? I see this test at the 100-day moving average. The 100-day moving average is my blue line, right? We have a severe market pullback, but MongoDB is at all-time highs. What does that tell you? There's some intelligent group of people who they're revealing their purchasing behavior of this stock, right? A NoSQL database company reveals to me that there's something going on here, right? So I learned technology through finance or through the stock market, right? Because it's like, oh, what is MongoDB? Then I jump into investor relations, start reading their what business they're in, and then it's like, oh, they sell a new form of database, right? Operational database. Is that correct? Okay. So MongoDB is good. Twilio is also good, right? Again, another one hitting all-time highs. I'm seeing a lot of bullish patterns in here as well. It's still holding the 100-day moving average, just not as perfect. So if you get a retrace back to the 100-day, then that's where I probably consider, a small options position. It's too aggressive right now. Like everything's like choppy up and down. This one's another one I found, but this one I categorize as a reversal. I think this one's a biotech company. It's EXEL. So I'm seeing activity in this. And this one rallied really hard, as you see right here. So this is technical analysis, Chris. What I see right here is probably an earnings call. They gapped up on large volume right here, and then retraced a bit, bounced off at the $16 level, right, off this major trend line right here, or midterm trend line, and now it went up. So I think a retracement to $20. Also, the 200-day moving average is a potential entry. You see, if I just keep talking like that for a while, it gets really boring. So I kind of, that's why I've done a bad job of just getting deep into technical analysis. But maybe in 2019, just for the sake of practicing your karate and mastering your art, I'll get back into talking like that. So that's what I'm seeing for EXEL. Another one is Trade Desk. Huh?
What was significant about 20?
It's significant because it's a psychological hold number, 20, but also a 200-day moving average.
Are you talking about like round numbers?
Round numbers is important. Yeah, round numbers is important. If you look at this, look, there's a 14 round number buy right here, right? You also see a lot of round number buy right here, at support right here at 16, right? Even at 18.
But this relative to the stock price too, like so a $300 stock, they're not tripping about 310, they're tripping about 300.
Trade Desk. So I don't know what Excel is, EXEL, but Trade Desk. This one's another software company, and what they focus on is if I get this right, if I recall correctly, they do marketing. It's called The Trade Desk, but it's not about trading. It's about right now in this world of data centers and mobile phones, things are growing, right? And everyone is paying on the back end side or on the business back end side. A lot of people are paying for marketing, and so they do it. They host a platform or exchange or a trade desk for people who want to market and people who want to sell digital space, and they broker that. That's a solid business model, in my opinion. The margins are pretty high on this one, but we're not going to jump into fundamental analysis. But what I'm seeing right here is, 2 earnings gap up right here on extremely high volume. So it's showing me that there's a lot of bullish indication here. But as of most recent in this market pullback, since October, we have a rounding bottom, right? And it looks like almost a cup and handle. So there's some bullish, it's also hanging out at, pretty near all-time highs. So to me, this is something to look at in a recovery, right? This is the market is, I wouldn't say secretly telling me, but publicly telling me that there's some strength there, which I like.
And I think this trader also recently tapped into the China market. They partnered with Dubai and then
Yeah. So that could be as well. But do you guys start to see like how I could just kind of see the sentiment from price action? To me, price action is king. It probably taught me global macro, right? Just analyzing the price action between gold, bonds, and currencies. But anyways, Workday. You guys know I've been screaming Workday for the longest time. They do enterprise HCM, but also FM, financial management. They acquired a company called Adaptive Insights, which focus on enterprise financial management. If you guys anyone know SAP or use SAP, right?
Yeah.
You know how big and powerful a corporation they are. I think probably still a $200 billion corporation, but they're located in Germany. What they do is they sell software, but a very important system for companies that rely on, it's diverse. The software is diverse, but mainly I like to think of them as a system for, this might be a wrong statement, but a system for supply chain or operations. Something with, a lot of the big clients are people with a lot of inventory that they have to perform logistics around, right? But these days, I don't know if you notice in the software space, if you're deep in it, there's a new trend to move away from, I wouldn't say move away from ERP, but what I'm seeing from the financial markets is, it's not, in ERP, there's CRM, HCM, not DBMS, but these other systems that an enterprise need. And what I'm seeing is that they're separating that. Like CRM is moving outside of ERP. Is that a correct statement?
Right, yeah.
Like,
so, personally, right?
Yeah.
Workday, we used to use some SAP thing, which was like, you only maintain it and stuff. With the Workday HR system,
Yeah.
everything is done through Workday. My annual enrollment for benefits, recently they
Yep.
brought it over.
Yep.
Right? And
They-
any small company can easily just pay through a check and get the service. It's pretty nice.
Yeah. There's
Compared to SAP's 9 disk which you need to install with 9 disks.
Yeah, that's true. There's a powerful reason for that, right? So you guys know I'm bullish on Salesforce. Again, educational purposes only. Just because I feel like they haven't fully realized their size yet. But what I wanted to show you, I think it was their third quarter presentation that I was watching or listening to. Where's the file? Where are the files? So, no way. Where's the presentation? So I wanted to show you, for the people who geek out to enterprise software, annual investor day at Dreamforce, Salesforce. It should be this one, but I don't see a file. Past events calendar. So, okay, I apologize for not having this resource on my hand, but it basically shows that CRM is the biggest. This is why I'm so bullish on CRM. By 2022, CRM is going to be the biggest enterprise software demand, right? Bigger than operating systems. What is operating systems? Microsoft and Red Hat. Red Hat is the enterprise level Linux versus Microsoft is, I guess you could say, retail and enterprise level operating system. So everyone has Apple's up there too. Bigger than operating system would be an ERP. ERP is a huge market. That's why SAP is worth $200 billion. That's why you need to know these things. If the total addressable market is huge, that's how big the company's going to get. right? And then bigger than ERP is I'm sorry, ERP is bigger than, I was gonna say DBMS. So DBMS is bigger than operating system. So MongoDB has a strong bullish case scenario as well, DBMS. Now, we're not talking about relational, but like the other models that are coming out. And I think MongoDB kind of has a monopoly in that, maybe. At least it seems like it. For someone who's into database, there's a website called DB Engines. I think, Sansa, you probably already know that one, right? I like this website. I think they did a good job of like just ranking the different database models. Let's see, DB Engines ranking. So look, Oracle, we already know that's like 150 billion plus in market cap. MySQL, Microsoft, SQL Server, Postgres, and then MongoDB. That's pretty high up there among the big boys like Oracle, right? So that's why I put, look, they're above IBM DB2. So that's why I think, and then Splunk's up here too. Kind of interesting. So those are securities that I'm pretty bullish on. And why is Splunk located near Santana Row? I'm pretty sure after a while I'm starting to see there's a sophisticated group of Silicon Valley investors that just kind of hang out near like Arista Networks. What road is that again? Arista Networks and Hortonworks and Dell and that area from Great America. What?
Great America, yeah.
Oh, yeah, Great American Parkway. Yeah, so I guess it seems like the most one. That and also Sandhill are where the collection of most sophisticated Silicon Valley investors hang out. So maybe I should hang out more over there and just like network around.
Do you think these companies pick your location to just get it's seen by?
Yes, location is strategic because when you do sales and I don't know if the client's flying to you or you flying to the client, they'd be like, oh, where are you from? Oh, next to Dell. Or like, oh, Dell's right across the street,
Yeah.
right? And so Michael Dell, he works pretty closely. Like I'm starting to see these I don't know the word for it, esoteric groups or like very sophisticated groups. Michael Dell and Silver Lake's right across the street. That's why I'm trying to like network with some of these guys. Eventually, they work closely together to do a lot of like end-to-end technology stack investing. They're investing in some great business models in my opinion. So I like following these corporate stories, just because maybe I aspire to be a venture capitalist. Oh, I told you guys already, VistaEquityPartners.com or whatever. That's the #1 private equity / venture capital firm. That gentleman, Robert F. Smith, is who I would aspire to be. Yeah, because he speaks the same language to me. So what he does is he focuses exclusively on enterprise software investing, and what he does is he flips the enterprise software businesses. This is a guy who sold Marketo to Adobe for $4.7 billion and made $3 billion on it, right? So this is who I look up to and like to listen to if I could find more interviews with the gentleman.
We were talking about Dell. I just wanted to bring up, there is a stock called DBMT.
Yep, DBMT.
Right? So Dell is planning to acquire it back at 120. Currently it's at 105.
Yeah.
Dell will pay 120 for those stocks. And also, if for those which it cannot buy, it will convert into a Dell stock, which is like 7x PE compared to IBM, which is like 8x, or HP, which is like 8 or 9x.
Yep. So I should have included Dell as well. This one's setting up a bull flag and it's high and tight. Not to sound cheesy or anything, but that's literally how they define some patterns. When you see a high and tight pattern like this, that's very bullish.
I thought that was a private company.
It was. It went private. So you could go you could go public, you go private, and then you go public again.
No, but DBMG, is that full Dell back in the public?
I think it's Dell Technologies, but it's a tracker.
So what they did was they said they acquired EMC and they said I can't give you full $31. I'll give you $24 cash and I will give for $6. I will give this DBMT stocks, right?
Yeah.
So then what they did, this is tracking VMware. VMware is at 150, 160 today, and this is at 120, right? So he did not track it very good.
Yeah.
So, but now he wants to go public again. So he's telling, I'm going to give 120 for whosoever wishes to sell it to me right now for cash. For rest of them whom I cannot buy, I'll convert it into a Dell stock.
Yeah. So going back to the enterprise software market, right? Like you guys hear me talk about this way too much. I really like this market because it's that simple as that pyramid I drew for you guys, right? At the average Joe level, transaction sizes are as big as probably an iPhone or a car. iPhone at 1,000, 1,500. and you get a little fee on that. A car is like 20,000 to, I don't know, 100,000, right? But the enterprise level, man, 100,000 is probably like the low end. You know, they transact a lot. And so I love it when I see something like a Workday where they treat it like, oh, everybody wants an iPhone, right? And in their world, or at least in the enterprise world, all these big corporations are like, everybody wants a Workday. And so I use that to analyze my stocks. And I see it. This is a Amazon ventured company. Amazon invested in Workday. So I think Workday has substantial upside. It's just this market environment is tough. Yeah.
You were saying even in this market environment, is it okay to start investing
Accumulate?
in there, or?
I can't, like I said, as much as I know, I feel like most people I think don't have a crystal ball. I have one, but I call it a super extremely fuzzy crystal ball. Better than not having a crystal ball. So I have an idea, right? Just a slight idea. But now that I understand global macro or sovereign level stuff a lot more, I see a major concern. And so if you ask me, am I more bullish on Workday or gold miners? Believe it or not, I'm more bullish on gold miners than high gross margin SaaS businesses. Like what the hell? These are, I really want to buy them like crazy, but and also BlackBerry. BlackBerry is another one. There's a story for BlackBerry. I know you're like, what the heck? BlackBerry so the gentleman who operates BlackBerry, he was a guy who took over, operated Sybase and sold Sybase to SAP. You know Sybase?
Yeah.
Yeah. And he basically now sits at BlackBerry, and he turned BlackBerry from 80% hardware, 20% software. He flipped it. It's 80% software. He acquired a company called Silence, and they're pursuing like AI and cybersecurity. So to me, I think, BlackBerry is the ultimate potential, just not in this global macro environment. That's the only issue. So in 2017, when everything was good, man, like every stock was just kind of momentum going up. It was an easier environment to make money. Now it's whatever, up a little bit, I try to take it. So, after I got hit by Yelp. So I had a large position on Yelp. But that taught me, I have to be upfront about it because it teaches me to become a better investor. The more wounds and battle scars you see on me, the better I become, I hope. Just kidding. But anyways, that's Workday. Enterprise HCM. Because if you think about the balance sheet deep enough, right? Assets over liabilities. There's one thing on the balance sheets, or that doesn't show on the balance sheet, is your employee count. Those are assets. Especially employees who know to develop software. Those are high value assets. And so HCM does track, that recruiting, payroll management, all that stuff, right? So I think it's a powerful subsegment of an ERP, or at least what I think an ERP is. The next one is a Chinese stock. Keep in mind this is an emerging market stock, but I'm seeing a lot of accumulation. It's NetEase. This one in 2017, if I recall, this one was going up like crazy. And Sylvia, I think Sylvia's online right now. We have some comments online. Hortonworks is now merged with Cloudera. Yes, so SK, I'm also looking at Cloudera because there's a lot of Stanford people or whatever, this sophisticated group. So there's 14 people online, but I don't think Sylvia's online. Okay, well she's not online today. But NetEase, she was looking at NetEase when it was going up a lot. I think, emerging markets is still a tough call for me. But I do see some technical accumulation over here, right? I see a double bottom, at least the automatic TA sees it. And then I see a breakout above 240 right here, also above the 200-day moving average. So this is showing significant strength, at least at this bottom. So this looks like a potential reversal, but I would treat it as a trade for now because I can't tell where EM's going. I can't tell where emerging markets are going. And then the next stock I have, so I have a few more stocks to share, guys. It's already 12 o'clock. I don't want to hold you too long. If you guys have to leave, feel free. Don't feel bad to stick around. So one of the bullish stocks that I am, the gold miner, the number 1, 2, or 3 is Agnico Eagle. It's kind of a catchy name, but I believe that when institutions need to run to gold, they're going to. And I'm already seeing a bull flag right here, right? So I see a nice dip, right, and then a solid long couple month consolidation support right here. And then a breakout above the 200 or at the 200-day moving average. It has resistance at the 200-day moving average and sitting right below 40. But this is okay because as it goes up on extremely high volume, right? That tells me like, okay, big players are accumulating. So I like this one, and I think institutions will run to this one. Because look, if you're a money manager and you need to buy something really quick, let's say, oh shoot, we need to buy the AI industry. You're not gonna run to like the 100 million market cap AIs. You're gonna run to the $1 billion ones. So this is the AEM is the higher end gold miner that has a track record of success. I was gonna show you a YouTube video. It's like some industrial stuff and like some gold mines, but maybe not now since I'm kind of crunched on time. I want to finish this. The next one I like is Etsy. It's looking really good and it held support really well at 40, right? And it's still going up. It's at all-time highs almost in this poor market environment. Now, I'm not a big fan of like fashion. This is what they do, right? Fashion, is it? Or is it more of the crafts broker? Okay, I'm sorry. I was thinking of a TradeC. Have you heard of TradeC? Don't ask me how I know that, but TradeC is like a broker for Louis Vuitton and Chanel stuff. I'm sorry, I was mixing that up. Okay, so Etsy, yes, crafts is pretty big. It's a niche software, consumer software. Though I don't think it'll grow as big as enterprise software. Next one I like is Data or Tableau, right? This is looking good. It's hitting new highs. What can I say? And these are relatively cheap stocks too. It held the 200-day moving average 2 times, or the $100 area. Now above 120, so looking good. The last few, Team Atlassian. I don't know if you guys heard of this company, but I'm seeing a reversal here, double bottom at the 200-day moving average, and then break of this minor trend line right here on some decent volume, I'd say, right? So it's looking like it's consolidating at this area and might hold 80 and go higher. And then we'll set up maybe even a cup and handle if you look at it hard enough. So that's looking bullish, right? Gold. This one's a gold miner. I didn't look deep into this one, but this one just looked good, so I put it on here. It did a nice reversal and tested 200-day. It hit the 200-day moving average, broke out on high volume over here as well, 2 times high volume, and then now sitting, tested the 200-day moving average several times, and now it's going higher. So I think there's something going on with this one. This one I would look for maybe a quick trade next week. KL, Kirkland, gold miner. This is my second favorite one after GG. GG is my number 1 favorite one. Second favorite one is KL. Again, probably not so much to talk about. 200-day moving average test double time. I guess you could say it's a double cup and handle, maybe. No. And then Splunk. Splunk is very choppy, but I see it performing relatively well. So keep in mind, in this next super cycle, when we recover or things get better, these are like, major. These are companies to pay attention to for, I say, a good 5 years, right? To trade around for 5 years, swing trade around for 5 years, because a sophisticated group or someone more informed is willing to deploy this much money to hold up the stock in a very bearish environment. So again, in a tsunami environment, this is what we're in. I'm seeing gold, or I'm seeing the diamond. So last one, okay? Last one is Starbucks. It looks good. And Bill Ackman is accumulating as well, or he has positions in it. Nothing much to say about it besides it has like a monopoly on coffee, or at least everyone goes to it to get their caffeine needs. I won't speak too much on that. I was going to talk about some short selling securities, but we'll probably skip that just because it's getting too long. I don't want to hold you back. Last few comments. So we already talked about Leon Cooperman, 3-point whatever billionaire hedge fund money manager, closed out his fund and saying, "Hey, I'm retiring at the top. I don't want to retire at the bottom." Fair enough. Fair statement. And then this one. So I probably won't read that one. I was going to go over indices, but we did in the beginning already. I already showed you that. Miscellaneous. Maybe we'll save it till next week, but this was an article I wanted to share with you guys related to real estate and how this analyst, who is also a practitioner, investor in the real estate market, also a lender and all that, he feels that he made a bold statement. And this guy blogs like once in a while, okay? And he just blogged most recently on Friday. So I got this information on Friday, all right? But he called it 30% off real estate prices. And I'll share it with you guys.
Say that again, 30%?
He feels that, I'll read the statement to you. And we'll close it out. We'll close it out from there, and maybe next week we'll talk about gold and blockchain. I haven't decided. It's a Christmas weekend, so maybe we'll call it a day, depending on what you guys want. Because I noticed like the crowd kind of shrunk today. It was a lot bigger last week, but this is what he said, and we'll close it out. 30. Let's see. So I'll send you guys the article and you can read it. And based on historical divergence between end user affordability, he's a real estate guy. He talks like an engineer. And house prices in top metros in the nation. He talks about Santa Clara as well, or San Jose or Silicon Valley. Today, house prices could fall at least 30% and only be fairly valued. I have plenty of local level data and models proving this. That's a bold statement.
Yeah, but inventories are still low. If you look at inventories compared to going all the way back and, you know.
So I have an answer to that as well. So this is another credible gentleman. I think he lives in San Francisco. His name is Wolf Richter. You can look him up as well. His website is literally wolfstreet.com. But he posted some data from realtor.com recently. If you look at 2018 inventories or active listings volume has increased, right? So there's more inventory on the market now because people are wanting to sell. This was if you remember in 2015 to 2016, the stock market had a lot of volatility. It caused this much inventory to go on the market. Remember that 1 year, 2015 to 2016, S&P 500 just went sideways?
Yeah, but this is percentage change relative to last year, right? So it's
Yeah,
just reflecting that last year was really, really low and it's gone up a little bit.
Yeah,
But if you look at absolute supply.
Absolute
relative to,
supply?
you know,
Okay, yeah, you're
15,
right.
20 year
Yeah.
period, we are
Where can I get data on that? I'm trying to like brush up on the real estate analysis.
Yeah, I'll send that to you.
Okay,
I
okay.
found it somewhere recently.
Yeah, so I mean, overall, this area is insulated. It's a strong environment. Don't get me wrong. Like, it's next to Apple. It's next to, well, it's not next to Microsoft, but Facebook and Google are here. So if you could just set aside and just look long term, it'll go up because they're going to print money. The moment they print money, real estate prices will keep going up.
Yeah, the other challenge is cost of construction is going up, and because of all
Taxes
these
and
immigration
insurance
issues,
and
labor is coming down,
Yeah.
and also you've had all these hurricanes and everything else
Mhm.
that's causing new construction to focus on rebuilding. So I don't really see inventory improving significantly because
I see.
I sort of keep on top of this market, and
Okay.
I think a lot of it is going into just keeping up with all the losses, you know, with fire and hurricane and everything else. So.
Yeah. So if anything, Santo is way more credible than me. He's the commercial real estate guru in here. But yeah, that's
Going back to S&P, that also affects housing, right? Because what's gonna happen if S&P keeps dropping at 10, 15, 20%,
yeah.
then people's confidence on buying properties is not gonna be there.
Yeah, I know.
Not only
It's
that, but then people that are selling are gonna just say, let me just drop the price, I want to get out of this. And just, that's gonna determine everything, right? If S&P makes a comeback and we get, you know, houses back on it. If S&P drops another 10%, you're gonna see the compound.
Especially in Silicon Valley,
Right.
where stock is so much of your net asset value here. Your net worth is all about stock.
yeah.
Here.
All right, guys. So that's a 2-hour session today. I hope it was a little bit different or new or staying interesting. Thanks, man. Well, you guys don't have to do that. That's well, makes me want to take the day off next week. Just kidding. But we'll see. So next week is Christmas. Do you guys want me to host one? Or I know volume is going to be light because when I had the mixer, Thanksgiving mixer. So I'm not doing a mixer this month. I normally do a mixer once a month. It was lighter on volume. We normally get 60 to 80 people. The last one we had about 40 people. So I'm not gonna.
Skip next week. It's like Christmas Day, isn't it?
Yeah. Well, Christmas is on Monday or Tuesday. So Monday's Christmas Eve. So that's why I was thinking. Because I don't know what I'll be doing, but maybe family might want to go out. But we go out a lot anyways. So I'll keep you guys posted. Maybe just take a look at the meetup, and if I decide to cancel, then I'll try to message everyone. Last time I messaged everyone, but I missed one person. So SK was at the door. he's not here today. He's actually online. So I apologize, SK. But anyways, let's call it a day. I'll stick around for like 10-15 minutes, and let me know if you have any questions. Yeah. Okay. All right. Thanks, guys. I'm gonna see what they said up here. We get Christmas gifts to next meetup. Yeah, I want to make Volatility Club shirts and give it to everyone. But I also crunched on time that I have to go communicate with China with like a vendor.
AliExpress.
Yeah, exactly. That's what we're doing already. Yeah, that's how the wifey's doing the whole watch business thing. Yeah, we got like a commercial coming out soon and all that. Okay, guys. Well, I'm gonna turn off the online and pack up and go do an open house. Last open house for the year. All right.
So
Hey.
does open houses staying on the market
Yeah. So the trend right now is home prices, whatever you list, it's going right below. It's selling right below. So I'm seeing like a 1.8 sell for 1.6, et cetera, et cetera. That's the trend. Not as exciting, but I think, you know, in the next downturn super cycle, we'll get some opportunities.
Do you see like
Thanks, guys.
like retirement age people, like people who are 65, 66, selling their big home and trying to downsize?
Yeah, it's a lot of people retiring out who build up like a lot of equity, man. Like I'm looking at some like the one right now, 1.2, they own it outright, 100%. They own 100% equity. All right, guys, online. Go online. I'm turning it off. We'll see you guys next week. Thanks so much.
People side, 90 people actually. They are like all on the website online then.